I've got this here.
The committee will come to order. Let me welcome all those in attendance this morning. I realize that we have standing room only here, and I would like to say to the press, as we've seen in the past, sometimes when the Fed chairman arches an eyebrow or tilts his shoulder one way or the other, it sets off a news alarm and people run for the door to report that. And I would ask today that as reporters come and go, that they do so in an orderly way and try to maintain as much quiet in the room as possible so that we can move along this morning. I think the overflow attendance we have today underscores the enormous importance of this hearing today and the whole question of how our economy is doing and where monetary policy fits into that picture. And so we welcome Chairman Greenspan today. He has been here a number of times before commenting on these very issues, and so there is an abundant committee record of previous comments and observations by the chairman, many of which we're going to want to ask about today a little bit later on in the question period, because I think a number of the comments we were given earlier have not been borne out very well, and I think we've got a need for some explanations in those areas. I'm going to make my own opening statement. I'll call on my colleagues to do likewise, and then we'll call on Chairman Greenspan for his opening statement. Chairman Greenspan, the accumulating evidence, I think, shows that the American economy is in serious trouble and that the damage is piling up everywhere we look. The Federal Reserve policy adjustments to help revive the economy, I think, have not worked effectively. And today we need some new candor and some fresh thinking from the Fed. Much of what we've heard before, I think, will not do in terms of going forward from this point. I think the record now clearly shows that the Fed monetary policy moves have been too little and too late, and that despite reassurances that you have repeatedly given this committee, the economy remains wounded and struggling today. Unemployment is rising, consumer confidence is weak, our trade deficit is worsening, and nearly 85% of the American people indicate in national opinion polls that, in their view, our country is on the wrong economic track going into the future, and they want to change to a new economic strategy that can lift the country. Numbers like that are unprecedented in all the time that public opinion measurements of that sort have been taken. Incomes of American households are declining, and it's not just the recession. Obviously, people out of work have an elimination of income, in some cases eligible for unemployment insurance compensation, but not all cases. But generally, quite apart from the unemployed people, if you take all people in the country, as I say, per capita household incomes have been declining. For the first time in more than 40 years, per capita disposable incomes have declined now over a full 3-year period. In fact, starting back when the current administration took office. And this is the first time, this is in fact the first administration in which the economy has declined on a per capita basis since that of Herbert Hoover. We have some charts here today that I'm going to refer to. We have one that's just being finished that will be brought up a little later. I'll refer to it in the question period. The first one that I want to refer to just briefly going through here is what has happened to unemployment. If you look at that chart, starting in 1990, the unemployment rate was down between 5 and 6%, but what we have seen coming through 1990, 91, now into the middle of 1992, that unemployment rate has continued to climb. It reached its highest level at the last month's reporting period of 7.8%, and there is nothing in that data that would indicate that we're likely to see it turn around anytime soon. Pat, would you take that chart away so I can refer to the second one? Also, if you take a look at what is happening as we deal with this long, prolonged recession, we have on this chart a line that depicts the way our economy has moved as we have come out of previous post-war recessions. We've averaged all of those together to see what our experience has been. And if you look at that chart, you will see that the average of all recessions goes down, such as we have seen in this depression, hits a low point, and then in all of those other recessions, we come out of that. We come out of it with a strong upward trend. We get back up into a positive area, and we start to recoup the losses that we incurred during the recession. But in this situation, the line at the bottom of the chart shows that we have stayed now down near the bottom of this recession in terms of this aggregate statistic, and it's looking more, instead of a V-shaped or a U-shaped comeback into a recovery, that we have kind of an L-shaped curve where we're continuing to stay down at a very depressed level. And in fact, if you look at the percent change in the non-farm payroll employment, as I say, it's actually turned down just recently. Finally, if I can just have that last chart for now, or the next chart here. If you look since 1950 at what has happened to real disposable personal income on a per capita basis, this is a 3-year average annual growth rate that's put out by the Department of Commerce. This chart goes back all the way to 1950. The first part on the chart is in 1950. It comes through all those successive decades. And despite the ups and downs, for the first time in that whole stretch of time, we have broken through the zero line, moved into a negative line in terms of where we find ourselves with the latest data. So again, it shows that this erosion of economic strength and erosion of living standard is not just for those that are unemployed, but as well for those that have managed to hold on to their jobs. Finally, let me have the last chart, and then I'll complete my statement. In the area of monetary policy, and this is an area that I think we're going to want to discuss at some length today with the Chairman, the Federal Reserve sets for itself a target growth rate for various components of the money supply, one of those being the M2 target. And what this chart depicts is that the Fed, having set its target, has not been able to achieve hitting even the midpoint of its target now over an extended period of time since 1986. If you take the top chart, the line, the dotted line, indicates what the target, the midpoint of the target range was for the Fed in money growth in M2. The blue line underneath that is what has actually been achieved. So you can see there has been a substantial shortfall, and in fact, if we had been up at the midpoint of that M2 target range, we would have a substantially higher money supply out there than is presently the case. But in a very ominous fashion, if you look at the chart on the bottom, you will see what is happening so far in 1992. Because while the Fed target range for M2 growth is between a figure of 2.5% and 6.5%, you will see that since February, it has been trending down. In April, it crossed below the low end of that range, moved below 2.5%, and through June, in terms of the latest data that we have, the data is still now outside the Fed's own range. I think that's very disturbing when the Fed sets a policy range that it thinks it's necessary to try to accommodate an orderly functioning of the economy, and then to find that the policy is not generating a result that even brings it within the low end of its own range. This committee has repeatedly urged the Fed, orally in this committee and in writing, to adopt a more aggressive economic growth strategy. And frankly, the Fed has resisted that. The Fed has applied the old-time economic medicine, strangling the money supply in the name of fighting inflation, and now unemployment has risen, as I say, to 7.8%, and I think it's likely to go higher. We are not creating the new jobs needed for new entrants into the labor force, despite whatever qualifications and training they bring. There are a lot of unemployed college graduates, graduate engineers, and others throughout our society today. In fact, over 15 million Americans are now unemployed, underemployed, or only able to work part-time because they can't find full-time work. And more massive job eliminations are being announced every day by companies all across the 50 states. Any stunted recovery that we have is almost invisible, with increasing signs that we may slide back into a third phase of this recession. As I say, on the Fed money supply issue alone, the target growth rate of 2.5% to 6.5%, and yet so far this year the Fed policies have malfunctioned, I think, badly enough that since April they've even fallen against the low end, below the low end of their own target range. Significantly, referring a moment again to the chart I had earlier up there, if the Fed had met just the midpoint of its growth targets for M2 since 1987, the money stock today in the country would be 8% higher than it is, and I think it's fair to say we would have a stronger economy as a result. So something is fundamentally wrong when the Fed is unable to keep M2 growth within its own target range, and I think the Chairman today owes the country an explanation for this failure and what can be done to fix it. I think the time has come for the Fed to frankly admit that monetary policy by itself is insufficient to deal with our serious economic problems, and that other, more aggressive economic growth initiatives are needed now. Just yesterday, the world currency and financial markets were in disarray, prompting a major currency intervention effort. But that was a one-shot deal that solves none of the underlying problems. And certainly higher German interest rates increase the threat to economic recovery here in the United States. Clearly, the world economic and financial order has changed fundamentally in recent years. But I have yet to hear the Fed offer a revised view of these new realities, to level with the American people as to the scale of the problems, and to advocate broader strategies that can restore sustained economic growth here in America. In fact, the Fed has continued to oppose the more encompassing economic initiatives needed to restore U.S. job growth, higher productivity, and broad-based economic expansion. The strategy has been to minimize and tiptoe around the problems while they have worsened, and public confidence, to a large degree, I think, has been squandered. And so during the question period, I want to go through this in detail because there is underlying what I've said. I'm not taking the time to do it now. But these questions, as you well know, have been put to you before in this committee. You've given answers on the record, and we've got to get to the bottom today as to why those answers have gone as far awry as they have. Senator Garn.
Thank you. Thank you, Mr. Chairman. First of all, let me ask unanimous consent that my full statement be placed in the record.
Without objection, so ordered.
Mr. Chairman, both Mr. Chairmans, this hearing reminds me of one that was conducted when I was a freshman senator, and Arthur Burns was chairman of the Fed at that time, and wasn't too much different a hearing in a way. Arthur was being blamed for all the sins of the economy, and afterwards talking to him, and I said, well, Mr. Chairman, I haven't been here too long, a year or so, and so on, but it seems to me there are other factors involved in this than just the Fed and monetary policy. Maybe I'm rather naive, but it seems to me that a few years ago, no one ever heard of the chairman of the Fed. They just didn't know who he was. And now we continue to hear and have for many years that the chairman of the Fed is the second most important person in the country next to the president. And I said, how do you explain that? And he said, well, Senator, he said, used to be we had some stable fiscal policy in this country. We had a Congress that tried to balance the budget and manage that side of it, and you can't really separate monetary and fiscal policy from each other. And my job becomes more difficult every single day to play with the M's in monetary policy when Congress will not responsibly deal with the fiscal policy. Well, that's nearly 18 years ago now, but I really believe that is the exact same situation, that while I would share some of the concerns of the chairman about monetary policy, I suppose I wouldn't be as nice as you'll be. I'd sit here if I were the witness and talk about fiscal policy and the failures of Congress. So obviously there's enough blame to go around. But I don't know how it's possible, like Arthur Burns said all those years ago, to separate monetary and fiscal policy. They do go together, and it takes cooperation on both sides. And I would say there's been a lot of failure on both sides, but certainly when you consider that the first year that I was here, that year I was talking to Arthur Burns, the total budget to run this country and defend it, with more than 40% of that budget going to defense, was $318 billion. The interest on the national debt just 17 years later is almost as big as the entire budget was just 17 years ago. And the debt this year will exceed by almost $100 billion. Almost $100 billion, what the total budget of this country was for everything just 17 years ago. So all I would suggest is that we look at this thing with some balance, and while we can be critical of you and the Fed for not being fast enough, slow enough, aggressive enough, unaggressive enough, or whatever, and again I would say maybe some of those things are correct. But on the other hand, I think the ultimate culprit is the Congress of the United States, composed of both Republicans and Democrats for the last couple of decades, who have been totally, completely irresponsible on fiscal policy. And until we start to work together on monetary and fiscal policy, one side can't solve the other. If we had our house in order, we couldn't solve it by ourselves. And if you did everything perfectly in light of the irresponsible fiscal policy of many Congresses over a couple of decades, you couldn't solve it either. And that's my main message today. Both sides need to start working together, or this problem of the economy will not be solved. Thank you, Mr. Chairman.
Thank you, Senator Garn. Senator Cranston.
I'll withhold my message until I hear Alan Greenspan's message.
Very good.
Okay. Thank you very much, Mr. Chairman. I'm pleased to join in welcoming the Chairman of the Federal Reserve in this semi-annual appearance. And we are obviously going to be very much interested in your discussion. I've just come back from several weeks. I've spent touring my state of Missouri extensively, and there's some areas where they report that jobs seem to be plentiful. Everything is working well. These are not areas, obviously, where there has been defense cutbacks or where slow auto sales have hurt the area, but by and large, I am struck that my constituents still have a strong worry about the future, and they have concerns about where our country is going based on what they see nationally. And I think as I talk with them at greater length, the cause of their unease is not monetary policy. They have said to me, you can't push on a string any longer. What they are concerned about is Congress's fiscal policy, the federal budget deficit, as my colleague and our leader from Utah has said. This obviously, the deficit is reflected in the steepness of the yield curve, the long-term rates essentially being beyond the capacity of the Federal Reserve to control. I hear a lot of discussions about the government regulatory burdens, which have increased significantly in recent years, burdens imposed by Congress and by administrative agencies, which many have cited as being the primary cause of the loss of jobs, or at least the failure to create new jobs. I find it somewhat ironic that you get to sit at the table and be grilled by us on monetary policy, when I'm sure that you could turn around and ask Congress quite a few questions about fiscal policy and about how we're conducting the business of this country. This should be a very interesting discussion, and I look forward to hearing your comments and to posing some questions to you. Thank you, Mr. Chairman.
Senator Kerry.
Mr. Chairman, thank you. Listening to the various opening comments, I guess it underscores the dilemma that we find ourselves in. A lot of fingers pointing in different directions, and a lot of blame to go around. Mr. Chairman, I think it must be particularly difficult for you to sit there because you're not responsible for all of what is happening, and I think most of us understand that, and that may be even gratuitous in the saying of it. I don't mean it that way, but you are the most influential economic spokesperson of the nation. And while I don't expect you to come up here and announce bad news or be as gloomy as perhaps you might feel inside, or some people might, with the obvious repercussions of your doing so, I think this is a time for real candor about the fix, if you will. I listened to my colleague, Senator Garn, blame it on Congress for fiscal policy. I must tell you, I think there's just a general fakery that Congress and the administration have engaged in, and I personally feel a lot of anger about it and a considerable amount of frustration. I am one of those few here who did not vote for the Andrews Agreement. I have not voted for the last few budgets, but we are quickly blamed for what is going on, all of us. And I think that those budgets and that agreement were the greatest fakery that we could engage in, based on false assumptions about growth, false assumptions about interest rates, false assumptions about unemployment, and ultimately false assumptions about the rate of deficit reduction. And everybody knew it when we entered it, and everybody even knows it better today. And it's that kind of fakery that has lost the credibility of the Congress and the entire governing process and left us all grappling for answers and pointing in different directions. And it's inexcusable. Now, I think today I would hope that you could share with us some thoughts about some things that maybe extend beyond monetary policy, which is obviously not the sole cure to this problem. Your staff has recently, the staff in Boston, been sending me, as I think they do others, a monthly report card on the national and New England economies. And it's a very good product, but the numbers in it are very disturbing. National unemployment rate up 0.9% since last year, the height of the recession, to a 7.8%. Unemployment in New England up 0.8%. In almost that same period, up to 8.3%. Consumer confidence down last month nationally. And in Massachusetts, over 10% of the population is unemployed in places like Brockton, Fitchburg, Lowell, Lawrence. And in New Bedford and Fall River and other places, it's upwards of 12%. We have higher unemployment today in almost every sector of our economy in Massachusetts than we did over a year ago, and the same can be said for most of New England. And obviously, every single one of those unemployed people has a particular story of agony to tell, Mr. Chairman, as you well know. I heard on NPR this morning, driving in, a story of a woman in Los Angeles, I think it was, in California anyway, who lost a $600 a month studio because she lost her job. 2-year-old son takes all her possessions, rents storage space, starts to live in the storage space without water, electricity, or plumbing until they discover her there, kick her out, possessions gone. I mean, that's been repeated over and over again. On July 2nd, the Department of Labor reported a huge, broad shrinkage in payrolls, totaling 117,000 jobs. Not the kind of thing you would expect in any economic recovery of any kind. And factories are continuing to fire workers by the tens of thousands, construction laying off people by the tens of thousands, even jobs in wholesale and retail are falling. Last month, business, health, and personal services let go 15,000 employees. And to all of this, in fairness, you at the Federal Reserve have responded dramatically, I might add. Slower than many of us here wanted, not at the moment that many of us thought it should have happened, but you have responded, lowering the discount rate 7 times over the past 18 months and the federal funds rate 17 times during that same period. And yet, incredibly, the monetary supply, after growing at a slow pace in 1991-92, has in fact begun to shrink since January up until this last reduction that you've just made. So we now have a 3% discount rate, a 3.25% Fed funds rate in this country, which is the lowest that it has been since President Kennedy was in office, and yet the recession-like recovery continues to engulf the country, and consumer optimism, as I think a couple of my colleagues have said, is just at an all-time low. Now, I think it ought to be obvious, and I look to you today for some statement to this effect, that monetary policy alone is not going to resolve this problem for this country. And for a long time, many of us here in Congress, notwithstanding the deficit which we all understand, I voted for Gramm-Rudman, expected it to do its job, and for 2 years it did, until the fakery set in. And with the fakery has come a doctrine of avoidance that has consumed government. And it is motivated by a crass desire to get reelected on the notion that we don't have to pay for anything, but we can still deliver services up to the level that people expect. We don't have to invest in our colleges, we don't have to invest in libraries, we don't have to invest in roads and bridges, we don't have to invest in railroads, we don't have to invest in research and development, but somehow the United States of America is going to compete anyway with everybody else in the world who is doing those things. Now, Mr. Chairman, you are the most influential voice in economic policy in this country, and it is time for us to cut out the fakery, and it is time for us to really consider what we're going to do here. And I think that if you were to speak up and talk about the relationship of the exponential growth in the economy that comes from investment, not government spending, but investment in infrastructure, in putting people back to work, and in creating that, I think we might begin to get a reality base with respect to some of the things we have to do in this country. Maybe you don't believe those things. If you don't, then there is a real gap between what most people in this nation are suggesting we need and what our chief economic spokesman believes we need. Business Week just recently, and I'm sorry to go on, Mr. Chairman, but I want to lay this foundation for this testimony today. Business Week issued a recommendation in its lead editorial, quote, remedies for a uniquely frail recovery, and noting that this recovery is not only weaker than previous recoveries, but fundamentally different, requiring, quote, flexibility and originality in policymaking. Business Week's recommendation to you were that you could purchase 30-year Treasury bonds in the open market to push the long-term rates down and jawbone the banks to reduce prime lending rates as well. To the Congress, Business Week suggested that we include a significant federal capital spending program that would pump money into low-tech roads and bridges, high-tech fiber optic highways, and worker training programs. And such programs, Business Week editorialized, should be regarded not as government spending, but as government investments that would generate jobs and improve the productivity of the workforce. There were other recommendations, but I hope that today we can get a sense from you at this critical moment of your report to the nation and of our brief time that we have legislative days left, even in an election year, that you will help us to understand what beyond monetary policy could make a difference and how we could constructively deal with this extraordinary problem of a unique deficit while simultaneously needing such critical investment in our nation. And I hope that we can have a constructive dialogue in the process. Thank you, Mr. Chairman.
Thank you, Senator Kerry. Senator Domenici.
Mr. Chairman, I joined today in the hope that Chairman Greenspan will give us the benefit of his expertise as to what we ought to do or what is going wrong in terms of the expectation of a stronger recovery. Frankly, the American people ought to know that we are not in a recession. The problem is we have not got out of the recession with a strong enough growth pattern to have an effect that is typical when we've had a recession and start a recovery. We don't have the big punch, the big growth that adds energy to this economy and puts people back to work in larger numbers and increases our growth more significantly. Frankly, I think you ought to tell us why you think that's happened, because I join with those in saying that while you might have done some of the things that you did in terms of interest rates sooner, it's obvious that you can't hardly come down anymore either in the discount rate or its interest effect. We are at with many numbers that would indicate this shouldn't even be at this low a rate. It's there, very, very low, and still it does not add the revitalization. And I think you ought to tell us, frankly, why, and at least as you see it. I'm somewhat concerned about a deficit that is as big as ours and that will come down for 3 or 4 years if we left everything alone, and then it'll go busting through the rafters again. To hear people say that we ought to spend a lot more federal money really disturbs me. Maybe I could be convinced that to spend $200 or $230 or $240 billion in the next 4 years would really revitalize the economy. Frankly, I think it might revitalize government, but I'm not sure the revitalization of government is synonymous with revitalizing the economy. I believe part of the American problem today is an enormous anxiety on the part of the average American. I think that anxiety doesn't have to do as much with their current state. I mean, clearly we have people without work. We have people that need better jobs. But people who have good jobs are also worried about this economy. And I think that's an anxiety that comes from fear in the future, fear as to what's going to happen in 3, 4, 5, or 10 years to them and their children. And I believe, more than anything else, a real commitment that the marketplace and average Americans could understand regarding fixing this deficit would do as much to restore confidence as anything. Not all by itself, a total recovery, but it's desperately needed, because what we are talking about when we have this big a deficit is that we are giving up in terms of our ability to produce, work, and have growth. And we are saying we can't do that, so let's just spend more than we take in, perhaps forever, until there's nothing left. So from my standpoint, I hope you will tell us today why the things you did in response to a prolonged situation of not significant increases in growth, why it didn't work. I think that's an interesting exercise for you. And of all the things that have been said, I think you owe us that, because you did those things expecting more out of this economy, or at least some of us assumed you did, and it didn't happen. I believe it has to do with structural problems in the American economic system and in the fiscal policy of this country. I don't think we can fix them in a minute or even in a year, but I'd like your views on what we ought to get started doing. I'm also worried about spending money on the one hand and taxing on the other hand, and saying because we're spending it differently and taxing differently, it's all going to work. I have a great deal of difficulty with a plan that says spend $220 billion in the next 4 years, tax $150 billion in new taxes, but everything's going to work out. It's going to really cause us to get going. I'd like you to address that kind of an issue for us. I thank the Chairman for calling it. It's very important that we hear from you, Mr. Chairman, and I join with those who have said it's not all your fault, but you do owe us an explanation, since your Federal Reserve is there for a very important purpose. In times of recession, you play a very vital role. We forget about your vital role in the non-recession periods. But my last one has to do with the banks and money supply. You might want to address that before you leave here. Something is amiss in terms of bank loans for businesses and growth, and maybe it's the economy, maybe it's something else, but I think you ought to tell us about that. Thank you, Mr. Chairman.
Thank you very much, Senator Domenici. Senator Graham of Florida.
Thank you, Mr. Chairman. I appreciate your holding this hearing, and again the opportunity to hear from Chairman Greenspan. The purpose of the meeting today is to carry out the statutory obligation of a report on monetary policy pursuant to the Full Employment and Balanced Growth Act of 1978. The title of that act, I think, is an accurate statement of what our economic destination should be: full employment, balanced growth. And the concern that many Americans and many of my constituents in Florida are feeling is, why are we not accomplishing those objectives of full employment and balanced growth, even though we have been using, I would say, in an extreme degree, traditional economic measures. We are in a period of super Keynesianism in terms of efforts to move us out of this recession. We have massive federal budget deficits indicating the degree of our government spending. We have some of the lowest interest rates in modern American economic history. We have a weakened dollar. All of those measures are traditional steps in order to stimulate an economy during a period of recession. In spite of that, rather than achieve the goal of full employment and balanced growth, we are seeing one of the weakest periods of economic performance. Mr. Chairman, I would like to submit for the record an analysis which was published in the New York Times of economic performance under 9 presidents, and particularly comment on 2 similar periods: the 1969 to 72 period, the first term of President Nixon, and the 89 to 92 period of the first term of President Bush. Gross domestic product during the Nixon period grew 12.4%. During the Bush administration, it has grown 2.5%. Jobs under the Nixon administration grew 8.3%. They've grown 0.7% under President Bush. Disposable income, 10.8 under Nixon, 1.2 under Bush. Industrial production up 14.7 under Nixon, down 0.4 under Bush. Hourly wages up 9.8 under Nixon, down 1.7 under Bush. Those are the effects of applying this accelerated set of measures of increased government debt and spending, lower interest rates, and a weakened dollar to our current economy. So the question is, why isn't the prescription working? What has happened to the patient that has caused the prescription that in the past has been successful to be so anemic? Some suggestions include that we're paying the price of the accumulated public and private debt, the loss of economic sovereignty due to the globalization of the economy, the shrinking middle class, constrictions on credit, especially as it relates to entrepreneurs and housing, and all of those have been cited as fundamental changes in the economy that have contributed to the fact that the old prescriptions against the current patient of the American economy not having the expected results. So I would be very interested in your analysis of what is the pathology of the American economy and why are the prescriptions not having the intended results, and what are the new prescriptions that you think we should be administering, both in terms of monetary and fiscal policy. Thank you.
Thank you very much. Senator Graham of Texas.
Mr. Chairman, I want to thank you for holding the hearing. I think it's very timely. I think it's very important. I hope that we can here today focus on what Congress can do. The only logic for having you here before the committee is to try to be instructed by you as to what the problems are and what we can do about them. We can all speculate on what we would have done had we been in your job, but none of us were in your job, and I guess the odds are very high that none of us will ever be in your job. And some would rejoice in that, and I am among that group. But we are here in the United States Senate. We have an opportunity today to do something. We have a relatively unimportant bill before the Senate today, at least in the cosmic terms we're talking about. Any member of the Senate could go over today and offer an amendment to cut the capital gains tax rate. Any amendment of the Senate, any member of the Senate today could go over and offer an amendment to limit the growth of entitlements. So what I'd like to ask, Mr. Chairman, is basically this. I'd like to ask you to tell us what we can do in the Congress to try to get the economy going again. We have two approaches that have been proposed. One approach is basically to raise taxes, raise marginal tax rates, impose additional taxes on business to increase domestic spending. Is that the path to recovery? Would we, if we increase domestic spending by $59.4 billion and raise taxes by $39.3 billion, would that benefit the economy? Would we help the economy if we cut the capital gains tax rate? I think the answer is yes. Would we help the economy if we reformed entitlements and dramatically reduced the federal budget deficit? I think the answer is yes. But basically, what I think you can do here today is to give us your views as to which path America should take. There are two paths that are being proposed. One is raise taxes and raise spending in order to get America moving again. Whether we're pretending, as Business Week would pretend, that it's not really government spending, what a farcical position to take when we're talking about phoniness and about deficits. But one path is the government path, more spending, more taxes. The other path, which has been proposed and which this Congress has consistently rejected, is a path of, number one, gaining control of spending. The President has proposed binding limits on the growth of entitlements. If we adopted that proposal, would it help the economy or would it hurt the economy, in your opinion? If we cut the capital gains tax rate, would it help the economy or hurt the economy? If we had a $5,000 tax credit for buying a new home, first-time home buyers, as the President has proposed, would that help the economy or would that hurt the economy? If we reinstituted passive losses in the real estate industry, which the President has proposed, would that help the economy or would that hurt the economy? So basically, what I'd like to do here today is not focus in on whether or not you should have increased the money supply faster. First of all, that time is past. Nobody disputes what you're doing now as being the right thing to do. I think we all believe that it is. The question is not what should you do now, because everybody agrees with what you're doing now. The question is what we in Congress should be doing now. Should we be raising taxes and increasing spending? Should we be cutting taxes and gaining control of spending? Those are two distinct paths that we can go down, and I think it would be very beneficial here today to get you to give us your view as to what we ought to do. Thank you, Mr. Chairman.
Senator Sasser, Chairman of the Budget Committee.
Well, thank you, Mr. Chairman. I want to welcome you this morning, Dr. Greenspan. It's always a pleasure to have you appear before the committee, and you come this morning, I think, at a particularly important time. Now, you're here this morning and you have given us, will give us your indication or your report on the economy. And I must say to you that I don't see much change in the economy from your last appearance before this committee, or for that matter, the appearance before that one. Certainly, unemployment is worse. There's no doubt about that. The June unemployment rate of 7.8% is the worst we've had in 8 years, since the major recession of 1983. Nearly 10 million people are unemployed, and that doesn't count the millions who are working part-time, who want to be working full-time, and that doesn't count the millions who've become so discouraged that they have quit looking for work. As we convene here this morning, 1 in every 10 of our fellow citizens is on food stamps. Now, just last week, it was reported that industrial production declined in June for the first time in 5 months, and the economy is mired in the worst period of stagnation since before the Second World War. And I've said it so many times, and others have said it so many times, that now it's, I think, become part of the conventional wisdom that the past 4 years have seen the worst economic performance of any 4-year period since the days of Herbert Hoover in the late 1920s. Now, today we hear what the response of the Federal Reserve is and has been to the problem that we're facing. The Fed has been called the greatest instrument of economic policy making in the world, and that may be a little hyperbole, but there's probably some truth to that. But my problem has been from the very outset, and I've discussed this with you now over a period of years, that the Fed and the administration, the Bush administration, have accepted the view that inflation is the big problem, that inflation has been the bugaboo which has to be defeated, and that the economy needed a soft landing that would be brought about by higher interest rates. That was what was being said in '88 and '89. The administration, and I think the Fed also, adopted an elitist economic strategy, and as a result, unfortunately, the economy, rather than having a soft landing, simply crashed on the runway. Now, the real problem as I see it, Mr. Chairman, is that the Fed and the administration don't seem to have a problem in taking the lead in fighting inflation with high interest rates. But they do have a problem when it comes to creating job growth and creating economic growth. Now, last year we had several noted economists that testified before this committee, if I'm not mistaken, Mr. Chairman. One was Dr. James Tobin of Yale. They also testified before the Budget Committee that there was really very little downside risk to a more expansive monetary policy. But the Fed and the administration ignored their advice and continued to cling to what I believe is an overly conservative and an overly restrictive approach. Now, almost 2 years ago, at what we now know was the start of this recession, Dr. Greenspan, you told me before this committee, and I quote, here's what you said: monetary policy has the ability to act quickly enough to support economic expansion, close quote. And this response came to a complaint that I was making at that time about interest rates being too high, monetary policy being overly restrictive for what I perceived to be an adverse economic time that we were moving into. Now, it's clear now that something went wrong over the last 2 years, and I'll be interested in pursuing that with you. But the problem is that the Fed has responded to this recession too late. You have reduced interest rates significantly over an extended period of time, but this was done so, in my judgment, at a very deliberate and incremental pace that came too late. And one of the major reasons is that the Fed's lower rates have consistently followed negative economic developments rather than preceded them. And I firmly believe that if the Fed had been sending a clear and consistent signal over the past 2 years that it was going to stay ahead of the curve on the bad news in the economy and exercise leadership in growth, I don't think we'd be in the present situation. If the Fed had concentrated on keeping the economy growing rather than concentrating on an exaggerated fear of inflation, and I think that is one of the very real problems with the central bank in this country. We simply are overly concerned about the problem with inflation and cannot seem to understand that we have a dual purpose here, one of growing an economy in conjunction with dealing with inflation. I don't think we'd be in the present situation. Indeed, we had the problem of between early 1988 and extending into the spring of 1989, the Fed pushed the federal funds rate from 6.5% up to an incredible 10%, at the same time that the economy was holding a fairly steady 4% inflation rate. So I think that is one of the real problems. The Fed has been behind the curve from the very beginning. Now, it's easy to claim 20/20 hindsight today, Dr. Greenspan, and I think you know of the enormous respect that I have for you and your judgment. But I would remind you that some of us were saying in 1988 and certainly in 1989 that inflation is under control, and let's don't kill the economy in an effort to dig an even deeper grave for inflation. Well, here we are today, and we're going to do the best we can from this juncture. But I wanted to make that statement, Mr. Chairman.
Thank you very much, Senator Sasser. Chairman Greenspan, we're going to make your full statement a part of the record. It's a lengthy statement, and I'd like you to summarize it as you wish today, and I hope that you'll also take the occasion to respond in your remarks to some of the points that have been raised by members. We'd like to hear from you now.
I shall, Mr. Chairman. Mr. Chairman and members of the committee, I'm pleased to have this opportunity to present the board's semi-annual report on monetary policy to the Congress. Earlier this month, when the Federal Open Market Committee formulated its plans and objectives for the next year and a half, it did so against the backdrop of an economy still working its way through serious structural imbalances that have inhibited the pace of economic expansion. In light of the resulting sluggishness in the economy and of persistent weakness in credit and money, the system on July the 2nd cut the discount rate by 0.5 percentage point and eased reserve market conditions commensurately. These actions followed a reduction in the federal funds rate in early April. The recent easings of reserve conditions should help to shore up the economy, and coming in the context of a solid trend towards lower inflation, have contributed to laying a foundation for a sustained expansion in the U.S. economy. Our recent policy moves were just the latest in a series of 23 separate easing steps beginning more than 3 years ago. In total, short-term market interest rates have been reduced by 2/3. The federal funds rate, for example, has declined from almost 10% in mid-1989 to 3.25% currently. The discount rate has been cut to 3%, a 29-year low. Despite the cumulative size of these steps, the economic recovery to date nonetheless has been very hesitant. Based on experience over the past 3 or 4 decades, most forecasters would have predicted that a reduction of the magnitude seen in short-term interest rates, nominal and real, during the past 3 years would by now have been associated with a far more robust economic expansion. Clearly, the structural imbalances in the economy have proven more severe and more enduring than many had previously thought. The economy is still recuperating from past excesses involving a generalized over-reliance on debt to finance asset accumulation. Many of these activities were based largely on inflated expectations of future asset prices and income growth. In short, an overbuilding and overbuying of certain capital and consumer goods was made possible by overleverage. And when realities inevitably fell short of expectations, businesses and individuals left with debt-burdened balance sheets diverted cash flows to debt repayment at the expense of spending, while lenders turned considerably more cautious. This phenomenon is not unique to the United States. To a greater or lesser extent, similar adjustments have gripped Japan, Canada, Australia, the United Kingdom, and a number of northern European countries. For the first time in a half-century or more, several industrial countries have been confronted at roughly the same time with asset price deflation and the inevitable consequences. Despite widespread problems, we seem to have at least avoided the crises that historically have been associated with such periods in the past. In the United States especially, important economic dynamics ensued as the speculative acquisition of physical assets financed by debt outpaced fundamental demands. In some markets for physical assets, such as office buildings, a severe oversupply emerged and prices plummeted. In others, such as residential housing, average price appreciation unexpectedly came to a virtual standstill, and prices fell substantially in some regions. Firms that had been subject to leverage buyouts based on overly optimistic assumptions about the future values at which assets could be sold began to encounter debt servicing problems. More generally, disappointing earnings and downward adjustment in the values of assets brought about reduced net worth positions and worsened debt repayment burdens. Creditors naturally pulled back from making risky loans and investments, and as pressures mounted on lenders' earnings and capital, some features of a credit crunch appeared. With borrowers themselves becoming more cautious about taking on more debt, as well as about spending, credit flows to non-federal sectors diminished appreciably. It is not that this process was unforeseeable in the latter years of the 1980s. The sharp increase in debt and the unprecedented liquidation of corporate equity clearly were unsustainable and would eventually require a period of adjustment. What was unclear was the point at which financial problems would begin to constrain spending and how strong those constraints would be. Forecasts of difficulties with debt and strained balance sheets had surfaced from time to time over the past decade. But only in recent years did it become apparent that debt leverage had reached its limits, inducing consumers and businesses to retrench. Moreover, the degree of retrenchment has turned out to be much greater than experience since World War II would have suggested. The successive monetary easings have served to counter these contractionary forces, fending off the classic bust phase that seemed invariably to follow speculative booms in pre-World War II economic history. Lower interest rates have lessened repayment burdens through the refinancing and repricing of outstanding debt, and together with higher stock prices have facilitated the restructuring of balance sheets. Indeed, considerable progress in this regard has become evident for both households and businesses. The much more subdued rate of household and business credit expansion has reduced the leverage of both sectors. Household debt service payments as a percent of disposable personal income have retraced about one-half of the run-up that occurred during the previous expansion, and further progress appears in train. Similarly, non-financial corporations' gross interest payments as a percent of cash flow are estimated to have retraced roughly much of the roughly 10 percentage points increase that occurred in the expansion. The improvements in balance sheets, together with the beneficial effects of lower interest rates, have been reflected in reduced delinquencies on consumer loans and home mortgages, increased upgradings of firms' debt ratings, and narrowed quality spreads on corporate securities. Furthermore, lower interest rates, along with 2 reductions in reserve requirements, have appreciably cut the funding costs of depository lenders, materially improved interest margins, and fostered the replenishment of depository institution capital. although greatly moderating the potential adverse effects of the necessary adjustment process on economic activity, monetary stimulus also has stretched out the period over which adjustments will occur. A more drawn-out adjustment of impaired balance sheets, as we now are experiencing, obviously is much preferable to the alternative, an adjustment through massive financial and economic contraction. Yet the ongoing corrective process has meant that the economic expansion has been hobbled in part by the continued restraint on spending by still over-leveraged and hence cautious debtors. Balance sheets ultimately will reach comfortable configurations, but even before then, we should experience a quickening pace of economic activity as the grip of debt burden pressures begins to relax. Last year, I characterized this process as the economy struggling against a 50-mile-an-hour headwind. Today, its speed is decidedly less, but still appreciable. Uncertainty about how far the process of balance sheet adjustment would have to go and for how long the spending retrenchment of over-leveraged debtors would continue has become a factor in shaping Federal Reserve policy over the past few years. This uncertainty has been shared by many other observers who, based on past experience, were somewhat skeptical about the strength and persistence of spending restraint by both the private and public sectors, and dubious about the persistence of disinflationary forces. Against that background, more rapid or forceful easing actions more than likely would have been interpreted by market participants as risking a resurgence of inflation. That would have led to higher rather than lower long-term interest rates. As I have indicated many times before this committee, lower long-term rates are crucial in promoting progress towards more stable balance sheet structures in support of sustained economic expansion. Bond yields have not come down more, primarily because investors have been inordinately worried about future inflation risks. While they seem to exhibit only modest concern over a reemergence of stronger inflation during the next few years, investors apparently fear a resurgence further in the future, to a large extent as a consequence of expected outsized budget deficits exerting pressure for monetary accommodation. Other forces have added to the restraint on the economy associated with balance sheet adjustments. The scaling back of defense spending has been retarding near-term economic growth. At the same time, budgetary problems among states and localities have forced painful cutbacks by those units and burdensome tax increases as well. In addition, the noticeable slowdown in economic growth in other major industrial countries since mid-1990 has further tended to depress demand for goods and services produced in the United States. Clearly, in this environment, with conflicting forces of expansion and contraction continuing to vie for supremacy, any projection must be viewed as tenuous. In this context, the central tendencies of the projections of Federal Reserve Board members and Reserve Bank presidents are given in the Board's report. They project that the economic expansion is likely to strengthen moderately to a range of 2.75% to 3% over 1993. Such a pace is expected to reduce the unemployment rate noticeably over the next year and a half. This outlook is supported by several considerations, including the stimulus now in train from recent interest rate declines and the progress being made by borrowers and lenders in repairing strained balance sheets. Some pent-up demand for business capital goods, housing, and consumer durables should surface as the incentives to spending retrenchment abate. In our judgment, the interest rate declines to date, working to offset spending constraints related to balance sheet strains, should not endanger the further ebbing of inflationary pressures. Even as the anticipated strengthening of the economic activity occurs, monetary policy will continue to promote ongoing progress toward the longer-run objective of price stability, which should lay the foundation for sustained economic expansion. The financial fundamentals, such as money and credit growth, point to a continuation of disinflationary trends, and the central tendency of our projections for CPI inflation next year is 2.25% to 3.25%. Were this to be realized, inflation would be about back to a pace last seen on a sustained basis around a quarter century ago. As I have often noted to this committee, the most important contribution the Federal Reserve can make to encouraging the highest sustainable growth the U.S. economy can deliver over time is to provide a backdrop of reasonably stable prices on average for business and household decision-making. The relationship between money and spending also has been profoundly affected by the process of balance sheet restructuring. The broad monetary aggregates M2 and M3 currently stand below their annual growth ranges despite the earlier substantial declines in short-term interest rates. My previous testimonies to the Congress noted that aberrant monetary behavior emerged in 1990 and has since intensified. We at the Federal Reserve have expended a great deal of effort in studying this phenomenon and have made some progress in understanding it. To summarize our findings to date, the weakness of the broad monetary aggregates appears importantly to have reflected the variety of pressures that rechanneled credit flows away from depository institutions, lessening their need to issue monetary liabilities. The public, in the process of restructuring and delevering balance sheets, found that monetary assets had become less attractive relative to certain non-monetary financial assets or to debt repayment. These disintermediation and restructuring forces have tended to boost the velocity of the broader aggregates. Increasing M3 velocity has been evident for some years, but the tendency for M2 velocity to rise was obscured until recent quarters by the opposing influence of declines in short-term market rates. M2 velocity appears to have registered an appreciable increase in the first half of this year, and the Federal Reserve has had to take the emerging behavior of velocity into account in deciding how much weight to place on slow M2 growth in guiding its policy actions. Looking ahead, the recent increases in M2 velocity may well continue, although the uncertainties in this regard are considerable. Predicting either the share of depository intermediation in overall credit flows or the share of money in the public's overall demand for financial assets is currently far more difficult than usual. Against this background of considerable uncertainty about evolving monetary relationships, the committee retained the current ranges for money and credit growth this year. These growth ranges are 2.5% to 6.5% for M2, 1% to 5% for M3, and 4.5% to 8.5% for debt. This year's ranges were carried forward on a provisional basis for 1993 until such time as additional experience and analysis can be brought to bear on the issue of monetary behavior. In any event, the FOMC will revisit the issue of its monetary and credit ranges for 1993 no later than its meeting next February. By then, more evidence will have accumulated about evolving monetary relationships. In light of the difficulties in predicting velocity, signals conveyed by monetary data will have to continue to be interpreted together with other sources of information about economic developments. I expect that the economic expansion will soon again gain momentum, which lower inflation should help to maintain. Although the economy still is working...
Mr. Chairman, because, you know, we've been listening and we're going to continue to listen until you finish, but I think if that's the punchline, that you expect economic expansion will soon gain momentum, I'd like you to elaborate a bit. I mean, what do you mean by that? Well, and what do you expect?
Why don't I finish my statement, Mr. Chairman, and then I'd like to go back to that very important issue, which I think is critical to the economic outlook of this country. Although the economy still is working its way through structural impediments to more vigorous activity, the advances that already have been made in this regard augur well for the future. Banks and other lenders, having made considerable strides in rebuilding capital, have greater capacity to meet enlarged credit demands. The strengthening of household finances to date has established a firmer foundation for consumer outlays, and the restructuring of business balance sheets so far, together with improved labor productivity and profitability, has better positioned producers to support sustainable output gains. These gains would be even larger if the federal government can make significant progress towards bringing the budget into balance, releasing saving for productive private investment, and brightening further the prospects for ongoing advances in living standards for all Americans. Thank you very much, Mr. Chairman, and I'm available to respond specifically.
Well, before we go to the questions, I want you to elaborate on what you mean here by when you say, I expect that the economic expansion will soon gain momentum. I think everybody's entitled to more than that. What does that mean?
Yes, the context of my prepared remarks and the result of fairly extensive analysis of the economy, which we at the Federal Reserve have been engaged in, has very clearly evidenced an extraordinary balance sheet restraint on economic activity. Economic activity is expanding. It has been expanding since the recession ended last year. It has been expanding at a subnormal rate. It has been expanding at a rate which has not been adequate to bring the unemployment rate down. Indeed, it has been too slow to prevent it from rising. But it is nonetheless expanding. And the major reason why it is falling short of over a long-term basic rate of growth which would bring the unemployment rate down is that the balance sheet adjustments which got so badly out of kilter during the latter part of the 1980s because of a dramatic decline in the value of assets, that restraint is continuing to this day. However, there are signs that we are now seeing that while we have not completed the adjustment process by far, that we are well beyond the halfway point and we're beginning to see various areas of improvement emerge. This has not been enough as yet to create an expansion in bank loans or bank credits. It has not been enough to create any evidence that I can as yet see of a quickening of the pace right at this moment. But the economy is expanding, and as the balance sheet processes continue to improve, then the pressure, that analogy which I used to a headwind, which is now still appreciable, will continue to slow down, and I think a far more normal, balanced economic growth will ensue. I don't know when that specific time is going to present itself. We are looking at a phenomenon which we have not seen for half a century. We do not have easy guidelines to make judgments of precisely when and how the adjustments are taking place. But we do have considerable amount of evidence which suggests that the healing process on the balance sheets, the repair of balance sheets, is moving ahead at a fairly significant pace. And we expect that when the time arises that balance sheets are back to normal, that we will be looking at a far more normal economic structure. I would like to say, before I think that everything will be in a balanced state by then, we do have this very large budget deficit, which, if it continues to hang on the economy, if it continues to stretch out and create very significant increased federal liabilities, that will be a restraint on long-term economic growth, because it is diverting private savings from productive capital investment, which is a necessary element in increasing productivity and standards of living.
Well, before we start the questions, Senator Sarbanes joined us. Did you have an opening comment you wanted to make, and then we'll start the formal questions?
I understand others have made opening statements. Yes. Is that correct, Mr. Chairman? Mr. Chairman, I'm pleased to join the committee in this hearing on the Humphrey Hawkins hearing, which we hold semi-annually. I must say that I'm very much concerned by Chairman Greenspan's statement, and particularly the line of questioning which you've just put to him. Yesterday in the New York Times, Chairman Greenspan, Kenneth Gilpin wrote an article saying that the Chairman Greenspan will try to explain to Congress this week why the central bank's efforts have not succeeded. Now, we've got unemployment at 7.8%. That's the highest rate since March of 1984. That's the official unemployment figure. The comprehensive rate, which includes not only those that are out of work and looking for work, but also those that are so discouraged that they're not searching for work, plus people that are working part-time who want to work full-time. They're looking for full-time work, but they can only find part-time work, is 10.9%, just under 11%. Last summer, you came in and told us, and I quote, "We are well on the path of actually achieving the type of goals which we've set out to achieve, namely a solid recovery with unemployment down to its lowest sustainable level and inflation wholly under control." And in February, just this past February, you told us that the steerings of a recovery then visible should take hold in the second quarter. Now, when we had the hearing on your reappointment back in January of this year, right at the end of January, I asked you whether, as I understand it, it's your view that nothing further should be done. And you responded, "Yes, that's correct, Senator. If I had my choice, knowing all the uncertainties, of which there are innumerable ones, but one has got to make the decision I would make at this stage is for the moment to do nothing." I subsequently asked you, how long do you think the unemployment rate is going to stay above 6%? Or what do you expect the unemployment rate to be for 1992? And you responded, "I would say certainly above 6%. I then asked, would it be at 7%? And you responded, "I wouldn't try to guess at this stage. I would say at the moment, unless this economy begins to pick up at a pace faster than I suspect it is going to, we are not going to get very much progress on the unemployment rate. We'll get some, but not a lot." And then Senator Regal asked, does that mean then it could stay above 7% for the year? And you replied, I would doubt that, and if it did, then I would say the recovery is non-existent. Let me repeat that. This is your response to Senator Regal's question, whether the unemployment rate could stay above 7% for the year. And I just insert there, it's at 7.8% at the moment. And you responded, I would doubt that, and if it did, then I would say the recovery is non-existent. If it stays above 7, especially if it edges higher, that is suggestive of very weak growth rate, or in fact even a decline. Now, not only has it stayed above 7%, it's done more than edge higher. It's jumped 0.3 of a point in 2 successive months, gone from 7.2% to 7.8%. So that we're now at the highest figure in over 8 years. And then we're told this morning that we're soon going to have momentum. Now, this article yesterday quoted one of the market analysts at the Chase Manhattan Bank saying, quote, Mr. Greenspan can say we are in a recovery, but there is no number he could point to say that it will pick up steam. And another Wall Street economist says, I think we can expect a depressing, rambling speech. This is from your testimony here today. But the real problem is that the economy is not responding to lower interest rates. Now, I don't have any of us feeling of the urgency that many of us attach, any of the urgency in your statement that many of us attach to the current economic situation. I mean, it's in many senses, we're back to repeating sort of what we've heard before, and each time you've come in, you've made these statements, and subsequent economic activity has not borne out the statements. I mean, you know, last summer we were, so according to you, we were well on the path of achieving these goals, et cetera, and yet we keep coming up against an economy that is lagging. In fact, the real interest rates in the country are higher than they've been in previous recessions. I mean, if you go back, I think that's correct. If you go back and look at the previous recessions, real interest rates were lower. The Fed had done more to try to stimulate the economy than has taken place in this recession. In previous recessions, 14 months after the trough, which most people now think is where we are in this recession, all the jobs which had been lost had been recovered. In fact, the Bureau of Labor Statistics testified at the unemployment hearings last week that we, in previous recessions, 14 months after the trough, had gained somewhere between 130% to 240% of the jobs. In this recession, we've gained 9%. I mean, we just continue to bounce along sort of at the bottom end of the recession, and yet we're constantly getting these, I think it's not unfair to say bromides, that sort of say, well, you know, it's working out, everything's coming out all right. I don't see it. And Mr. Chairman, when my questioning comes, I hope to have the chance to explore this in greater depth with the Chairman.
Chairman Greenspan, let me just say to you very directly, I think it's fair to say we've had a very good working relationship with you on this committee, and we've worked on a lot of issues here in public session. We've worked on them together privately, and we'll continue to do that because of the nature of the, I think, constructive working relationship that we have. Having said that, I have to tell you I'm very disappointed in the statement today. I don't really think it does say much, and to people out in the country that are really struggling and sliding backward, of which there are now a vast number. The unemployment rate in my home state right now is 8.8%. California, you know, is struggling in real difficulty. It's up to 9.5%. And the people who are out there in that situation are not finding alternative jobs. As jobs are eliminated, they're not finding replacement work at the skill levels that they now have, and they're increasingly desperate to find work. That is separate from the problem of all the people whose per capita income has been sliding backward, who still have their jobs. And what I get out of your statement is that stay the course. That's the bottom line. You say here in the line that I ask you to elaborate on, I expect that the economic expansion will soon gain momentum. I don't think that's a sufficient statement for you to make in light of what you've said repeatedly on the record in this committee, because you've said that before, one way or another. Senator Sarbanes has just cited some of those quotations. Why is there any more reason for us to think that you're right this time when we look at the record and see that you've said essentially the very same thing before in past months and it's turned out not to be right, especially when the unemployment continues to rise?
First of all, let me just say that 6 months ago, when I was before the committee with respect to the February Humphrey Hawkins testimony, where I indicated many of the types of remarks that Senator Sarbanes suggested, our official forecast at that time for 1992 was lower than it is today. We have revised up our numbers. Now, it is certainly the case that the unemployment rate is higher. The gross domestic product, the most gross domestic product was revised up from a central tendency of 1 3/4 to 2.5% to the current forecast for the year of 2.25% to 3.25%. Now, unfortunately, do
you have an unemployment forecast?
Yes, I do. I was about to get to that. Where we did go wrong is we did not anticipate the extent of extraordinary rise in the labor force that has occurred during the last 6 months. It is an extraordinary rise, far greater than anybody had forecast, and as a result of that, our judgment as to where the unemployment rate would have been was very closely related to that particular issue. And indeed, I was quite surprised at the unemployment rate going as high as it did. The ratio of employment to population is the same now as it was at the beginning of the year. But the increased participation of in the labor force by the population has created a significant rise in the unemployment rate. But as far as forecasting economic activity is concerned, if anything, we've revised our numbers upward, not downward. And as best we can judge, while the growth is clearly subnormal, it is still growth, and it's been growing at a fairly persistent rate. It is not, as we have discussed before, at a level which I would consider adequate to restore economic balance, but we do have growth.
Well, wait just 1 second. I want to ask you to refer then, put that answer in the context of this chart that shows what the average recoveries have been in other post-war recessions versus what we've seen so far this time. I mean, the gap is so vast. I mean, I don't hear you saying anything to the people out in the country that are in real trouble except, you know, hang on, that sometime in the future we hope and think things will get better. We can't tell you when. We can't tell you how much. And we realize we've been saying it over and over again for months, not just in the report that you cite. You've been in here on other occasions saying the same thing. You said the same thing last year to us. And what is happening is people in the country don't have any confidence anymore in what's being said because the economy is not showing the kind of strength that it needs or that we've seen in the past. Now, something's changed, and it seems to me you're using the same old policy formulations. I realize that inflation fighting is number one on the list of goals down at the Fed. That's obvious from what you've said here today. I don't think that's sufficient. I don't think the country is giving you a signal that they think it's sufficient. The country wants more growth. They want more job growth. And to simply say, we're not quite doing as well as we've done in the past, that's no answer.
No, but Mr. Chairman, I think that, first of all, let's distinguish between what is happening in the economy, what it is that we at the Federal Reserve were projecting in the past, and what's happened since. The actual numbers on gross domestic product have pretty much followed the projections that we've been making.
But they're inadequate. I mean, forget the projections. The point is your plan isn't strong enough.
I don't disagree with that, and that's the reason why we have moved interest rates down as much as we have. This has been an extraordinary decline in short-term rates. It's been an extraordinary expansion of liquidity. It would be the type of liquidity, were it not for the case that we are confronted with this very unusual circumstance, would have been a highly inflationary and irresponsible degree of monetary ease in the context of the past. It's only in the context of this very unusual situation that the amount of ease that we have introduced is capable of containing what we consider to be a major financial problem in the context of not setting off a renewed bout of inflation, which would create much more difficulties for us in the future than I think we contemplate. This is not to say that we have not, in Federal Reserve policy, moved very appreciably towards an endeavor to create adequate liquidity and to make sure that what positive forces are moving are indeed financed. And to that extent, I think we have succeeded.
Well, let me just say, and I'm going to yield to Senator Amato, who's come in for an opening comment, and that is this. I don't think the policies have succeeded, with all due respect, and I don't think the American people think so. Now, there's polling data all over this country that'll tell you that. I have one here from the Los Angeles Times. I don't have the time right now to get into it. I will later. The public isn't buying this.
I didn't say that the policy overall has created a viable economic environment. What I have said is that
that's helpful that you make that clarification.
I'm making a very specific, focused point on creating adequate liquidity to confront a very serious balance sheet problem which has emerged not only in the United States, but has been a problem confronting many nations throughout the world for many of the same reasons.
Well,
the M2 rate has grown less than the bottom of the Fed's range. How can you talk about monetary liquidity?
Well, we've covered that earlier, and we'll come back to this, because if the goal is liquidity because you've got a financial structure crisis, in a sense, that you're trying to deal with, and that's the whole thrust of policy, at least that is a more straightforward statement of what policy is aimed at. And when we see this body count in terms of higher and higher unemployment, at least we can understand why the emphasis is one way and not another. Let me call on Senator Amato for an opening comment, then we'll continue on with the question. Senator Amato.
Thank you, Mr. Chairman. Chairman Greenspan, I believe that the Federal Reserve has acted in an almost timid manner and has reacted instead of being ahead of the curve. And I think it's exacerbated the problem. For anyone to suggest that the Federal Reserve has created the problem, I think that would be an overstatement. But it's been well over a year now, and we've talked on the issue of making the kinds of cuts to help stimulate the economy instead of first getting the bad news as it relates to employment and other statistics and then reacting. Consequently, I think that it shares a good part of the blame. Secondly, if one were to look at the differential in terms of the yield curve, and I know that you've read the Wall Street Journal from cover to cover, and yesterday, steepest ever yield curve may mean it's time to invest. Now look, the policy of the Fed to lower and get lower interest rates doesn't work if commercial banks do not increase lending activity and if they're going to buy government paper. Now, why should they go out and loan to the general public when the differential between what they can get with a long-term security, 5 years, sometimes close to 8%, no risk, no regulator looking at their back, why should they do that? Now, let me tell you, I brought this up to the Secretary of Treasury. I raised it with you. I hear nothing but we're going to study. And if one looks at the record, we find out that the banks have increased their portfolio roughly 20+%, $125 billion in the last year in government bonds, while decreasing their lending activity to the private sector by 4%, about $25 billion. It seems to me that the Fed could play an important role in this by buying those government securities, thereby reducing that spread. I think there's been a total failure to help. Now, that doesn't mean that in terms of the deficits and other problems, in terms of tax policy, we might not be able to stimulate the economy, bring more productivity into certain areas, real estate, etc., by passing some of the President's programs, $5,000 tax credit for first-time home buyers. But I have to suggest to you that as it relates to the coordination between the Treasury and the Fed, it has been abysmal. It has been poor. And the fact that I did not vote for your confirmation here on this committee, I just think that you just continue to do the same thing. You respond rather than look ahead. And for you, month after month, almost 2 years now, to be coming up here singing the same song, telling us about the economic recovery, just tells me that you and the rest of the group are in this ivory tower, and you don't know what's taking place in Main Street. You haven't taken the time to speak to the little businessmen. You don't believe their stories of available credit not being made available to them. And we're talking about people who are credit worthy. We're talking about the contraction of credit. Your policy, and it's yours and it's the Treasury's, has exacerbated the problem that we have today. And it's mind-boggling to me that you just continue it. And we hear nothing but excuse after excuse after excuse. It's a failure of leadership. Thank you.
Senator Domenici, order. We're going to have order in the room.
Chairman Greenspan, you indicated that the balance sheets were beginning to move in the right direction, and that, in your opinion, bodes well. Are you also talking about the balance sheet of families, of the working people of the country, of the middle class, or are we just talking about business and industry?
No, I'm talking about balance sheets of households and balance sheets of businesses, small, large. The household balance sheets have been under very significant strain as debt service charges have gone up. That is, we had a rise in the ratio of interest and amortization charges on household debt, which moved up above 18% of personal disposable income as debt expanded very dramatically in the 1980s. About half of that rise that occurred in the 80s has now been reversed, and from what we can see in the process of the most recent data, that adjustment is occurring quite rapidly at this point.
Do you have any way of measuring that remedying of itself out there in the marketplace in terms of how much has to occur before people and businesses start spending more money?
Yeah, I would suspect that we're getting very close to that point, and that's the reason why I raised the question, why I sense that some degree of acceleration is probably not too far into the future. All we know at this moment is that the repayment of consumer debt continues, but we also know that the very dramatic decline in interest rates has reduced the payment costs on both mortgage debt and in consumer debt in a very appreciable manner. And it's that process which in the household sector is moving at a pace which is far more rapid than it has been, and one which would presumably begin within a reasonable period of time to create increased incentives for consumers to start again purchasing both large ticket items and spending in the consumer areas generally.
Chairman Greenspan, it's my understanding and recollection that at the end of 1900 and of the 70s, that is 79 and 80, 81 period, interest rates were in excess of 21%, inflation was in excess of 15%, and unemployment ended up in excess of 10%. Now today, if my numbers are right, we have 17 million more Americans employed than we did then. You are telling us that part of this unemployment number is because more people are seeking jobs than you had anticipated in your projections, and that accounts for some of the unemployment. What caused the increase in job seekers during this recessionary period such that economic growth as you projected it, in fact it is higher than you projected, did not bring unemployment down?
It's still a puzzle because where a significant part of the so-called participation rate of the population occurred is amongst adult men, which has been a relatively stable ratio over the years. We have seen continued growth in the number of women, say 25 years of age and older, going into the workforce as a percent of the population. That has slowed down some. But we had a fairly dramatic decline in men a year or so ago, and that looked to be stabilizing, and we presumed that the fairly stable, in fact slightly declining ratio overall of participation in the labor force would continue, which meant that effectively the ratio of employment to population would be relatively stable. That forecast has turned out to be correct. The forecast which was wrong was we did not anticipate the rebound in the proportion of men, adult men, in the labor force. We are not sure whether that is a statistical aberration or it happened in the real world, but the numbers that create this very significant rise in the unemployment rate in recent months occur largely as a consequence of that phenomenon.
In my opening remarks, I indicated that obviously, to some extent, the policies that you had carried out were not moving the economy ahead as fast as any of us wanted. I don't think as fast as the President would like. And I wondered if you would give us any suggestions as to what we ought to be doing aside from your particular activities. And I think you nodded that you would. Would you share with us today if there is a concern that we ought to be moving this economy at a higher pace, what your suggestions are?
Well, at the moment, what we are observing is a process which, looking at the underlying workings of the structural difficulties, what we're looking at is a gradual solution to these underlying problems. And I think that getting the as I indicated to you earlier, I suspect that as far as consumers are concerned, we're getting reasonably close to where increased consumer spending will be a significant factor in the economy. But unless plant and equipment expenditures, capital goods, begins to accelerate, it's very difficult to make the case that the economy's rate of growth will accelerate. We have had a marked improvement in profit margins, largely because productivity is improved so dramatically, and that's one of the reasons why, even with the economic growth that we see, the level of employment is quite stagnant. But what that implies is that profit margins, which had been depressed very significantly, are now beginning to open up. And that process historically has meant, usually, that capital investment would begin to move. If that process falls into place, then we will get an expansion which I would say to you would be sufficiently adequate to bring the unemployment rate down significantly. And implicit in the forecast of the Federal Open Market Committee's members is a projection which has certain of those characteristics in them. If that does not occur, then it means basically that this process is undergoing a far more stretched out procedure. I don't believe that's happening. And I don't agree to the fact that looking back 6 months, 9 months ago, that the economy has in fact moved so differently from that which we expected at that time. It is certainly the case, however, that the unemployment rate is much worse than we'd expected. But that is not true of real economic growth. And the problem here is that unless and until we get economic growth picking up to a somewhat higher level, we are going to have considerable difficulty in moving the unemployment rate down. I think we are confronted with a very serious policy choice. I would not deny that there is the possibility that were we to engage in some fiscal stimulus at this stage, that we would accelerate the near term. I think, however, that that is highly risky, and in my judgment, probably could, in an analysis of where that would carry us in the longer term, probably be counterproductive. I think we were all very much chagrined when the budget deficit accelerated as much as it did in recent years during a period of economic expansion, because we all knew that at some point, after an extraordinary expansion of economic activity during the 1980s, the economy had to turn down. As I've said before this committee on many occasions several years ago, the business cycle is not dead. It's still out there and will get us at some point. But when it would emerge, we would be confronted with a very substantial deficit which would delimit our capability of engaging in the type of fiscal policy actions which so many times in the past have proved useful. And so I think we've arrived at this particular point in having allowed the deficit to get out of hand where our choices are really quite limited. I do think we could move ahead with a fiscal policy mix, but I think only at a significant potential long-term cost, which in my judgment I think it would be a mistake to engage in. I must say to you, I do not believe this notion that we can, quote, jumpstart the economy. I think that is an unfortunate analogy which does not apply to economic processes, and the more relevant consideration or analogy is more the question of turning an ocean liner around fairly quickly. The way which we have to revivify this particular economy is going to be different and more difficult than I think we've had in the recent cycles. And I can't give you an easy answer to what is doing. All I can tell you is to report on the fact that I do believe that the economy underneath the structure that is now evolving is improving, that while we are not getting the response that I would like to see as yet, I do nonetheless expect to see those responses. And I think that the reason we have, after producing such an extraordinary decline in short-term interest rates, have not gotten the response in the economy is an indication of how difficult the structural imbalances in balance sheets were. And I think the reasons why very similar policies in other countries are having precisely the same problem is an indication that this is a worldwide phenomenon which has gripped the industrial world, and one which I would say at this point the United States is far more advanced in coming out of it than our trading partners are.
Boy, I must say that sounds an awful lot like it's, recovery's right around the corner.
No, Mr. Chairman,
with all due respect, but you have said in virtually the same words that you've just used now, you've said this to us now repeatedly, stretching back for at least a year's time, and I can.
But there is a difference.
I give you the citations, and you see the risk on the one hand. I don't think you see the risk in terms of all the damage that is happening to the economy. You don't seem to be able to see that. You see the future risk, the inflation risk. But the damage in terms of all the unemployment and the business failures and the loss of confidence and the all kinds of massive job eliminations and so forth that are going on, you look at that and you have a very benign reaction to it.
No, I don't have a benign reaction, Mr. Chairman. I think it's a very serious problem. As you may recall, in a past committee meeting, I said to you that I had never seen such a degree of concern on the part of the American people with respect to our future. That is something which I am very seriously aware of, very much concerned about, and one which I find is the major issue which confronts the economy. But I also want to point out, Mr. Chairman, that the economy has been increasing. I mean, we are talking here as though it has not changed. What I had said in the past is that we would get a moderate recovery going. We have a moderate recovery. It's not as though the events have not unfolded the way we suggested they might. They have. We have a growth rate now which is relatively consistent with what we have been forecasting for almost the last year. The one area where we have been off and off badly, which I acknowledge and which I find difficult to fully explain, is the unemployment rate, which is essentially a labor force question and not an economic growth question. And I'm not saying to you that there is not great distress out there. I see it all the time, and I run into it all the time, and it's something which we should have very great concern about. But we should be very careful not to take actions which are short-term, quick fixes to a problem, the costs of which we're going to pay at a much later date. I think we've had too much of this extraordinary increase in deficit spending, deficit increases, for which I think we are paying a very major price. We don't have the capability of continuing to expand this budget deficit without longer-term consequences.
Yeah, well, massive unemployment increases the budget deficit, doesn't it?
I would say that weak economic growth increases.
Well, and that's exactly what we've got, and it's helping to drive up the deficit. Senator Cranston.
The Los Angeles poll, Los Angeles Times poll that Chairman Regal referred to, indicates that just 19% of Americans expect an improvement in the U.S. economy, 22 foresee worse conditions, and 54 expect no change at all. Do you foresee any or predict any actions occurring or events developing or plan any specific actions that you believe will improve the situation in a significant way in the not too distant future?
You talking about monetary policy?
Whatever.
Senator, we, as I've indicated in my prepared remarks, have moved short-term interest rates down very considerably. We have been confronted with, in many instances, indications that credit is not moving, money supply is not moving. Indeed, we have been most concerned about the fact that bank loans have been relatively stagnant for quite a while. And that has been the reasons why we have responded in an endeavor to create an environment in which to create incentives to lend. The problem that we have got, as best we can judge, is twofold. One, that there is indications that a number of institutions are concerned about their capital and therefore are not lending, and as a consequence of that have created what we have in the past described as a credit crunch, which effectively impacts on small and medium-sized business lending. But there's also very strong evidence that the general demand for loans is quite low. And as a consequence of that, a very substantial amount of economic activity has been financed by internal cash flow, that is, either consumer incomes for households or cash flow for business, and that the demand for funds is not very great. So that while we are seeing a general weakening in the overall credit structure, we nonetheless are seeing economic activity still expanding at a moderate rate, which means that the system is to a large extent bypassing the intermediary process. Now, a number of actions, I think, are obvious when one looks at this type of phenomenon, meaning it's not standard monetary policy as such, because we've engaged obviously in a fairly massive degree of endeavors to increase liquidity. But we do have structural problems here, and as a consequence we are looking at issues such as the leverage ratio, which is one of the elements that we imposed when the risk-based capital requirements were imposed for banks. And as we have indicated in several comments and public issuances, we are trying to create a change, an addition to the risk-based capital guidelines for banks, which will enable us to eliminate the leverage ratio for banks. And in my judgment, that is a material issue which is affecting the banks, even though at this particular stage the aggregate demand is still quite weak. So in one area that we are looking to improve the transmission from monetary policy into lending, one of the areas would be in this area, and we hope that we're going to be able to eliminate the leverage ratio sooner rather than later.
It seems to me that the situation that you described as a lack of aggregate demand for credit may be analogous to the people who are unemployed and have given up on looking for work at the present time. I think many business people have searched hard for an institution that will make a loan to them, and they've sort of given up because they've found it very, very difficult to obtain adequate credit any place. Do you believe that that is about to loosen up and that there will be more credit available?
Well, certainly to the extent that we are able to first bring the interest rate risk that we endeavor to embody in our capital requirements into the broad risk-based capital system. Once we're able to do that, I think we will ease up in certain areas with respect to capital restraints. The trouble at this particular stage is still more that there's a lack of demand for credit. People have overborrowed, and they have decided essentially that they've got too much in the way of debt and have been paying it down at a very pronounced rate. This is the reason why the reduction in interest rates has had such an extraordinary effect on the restructuring of balance sheets, because as mortgage rates have come down, there has been a very dramatic reshuffling of mortgage credit in a manner which interest payments by mortgage holders, mortgage debtors, have come down quite dramatically, and it's that process which is improving consumer balance sheets very dramatically, and a similar process in the business sector is creating a much improved balance sheet structure for business which will enhance capital investment. And it's in these two areas where monetary policy is effectively moving balance sheets towards a position which will be supportive of economic activity.
Thank you very much. My time's up.
Senator Graham.
Thank you, Mr. Chairman. Chairman Greenspan, I want to refocus our discussion, because I'm afraid that what has happened here is that everybody has said we're not blaming you for the recession, and then very promptly everybody has blamed you for the recession. You have talked about monetary policy and talked about your past predictions and talked about your current policy and what you're doing, but what has been left out of this whole discussion is the fiscal policy part of the equation. And I simply want to tick off a series of policies, and I want you to tell me in your professional judgment, if we all share the common goal of getting America out of the ditch, putting our people back to work, generating economic growth, would these policies help or hurt? Number one, adopting the President's comprehensive program to gain control of entitlement spending by setting binding caps that trigger reform in entitlement spending. Would that help or hurt in putting Americans to work and in terms of generating economic growth?
Well, Senator, I don't want to comment on any particular proposal, but if you were asking me whether or not restraints on expenditures generally would be productive to the long-term growth of this country, most certainly.
Okay, let me ask you another one, and this is a bipartisan proposal. It was defeated by 9 votes in the House. It failed on cloture by 2 votes in the Senate, and that was a constitutional provision mandating a balanced budget. If the balanced budget amendment to the Constitution had been adopted, and if effective implementation legislation had been put into effect, would that have strengthened the economy, help create more jobs, help generate more economic growth, and would that have helped to bring down long-term interest rates?
Well, Senator, as I have testified before the Congress, I would far more favor, if we're going the constitutional route, to have an amendment which would require supermajorities for expenditures, but not at the outlay level, but at the authorization and the appropriation level, with sunset legislation for all entitlement programs. My view is that if it is worth spending public monies, one should readily be able to get supermajorities rather than 50% when it's very easy to, because it is very easy to spend public monies if you don't have to finance that. In my judgment, that sort of amendment would contain expenditures quite significantly in precisely the way your first question was addressed, and I would prefer that to merely a stipulation that requires the Congress then to put implementing legislation through, because a constitutional amendment which would restrict, which would require, say, 60% or two-thirds majorities for every money bill automatically constrains that particular activity without implementing legislation, and in my judgment would go a considerable distance towards bringing the budget deficit down and not confront us with a situation in which we might have a constitutional amendment, but we would fail in the implementing legislation which would be required to address it.
Well, the amendment we voted on required 60% to increase the deficit, 60% to borrow money. Do you believe, had we cut the capital gains tax rate 3 years ago or last year, on both occasions we had votes, on both occasions it was defeated, do you believe that that would have helped the economy had we done that?
Yes, I do, Senator.
Do you believe that increasing domestic spending and raising tax rates, raising the AMT and raising the payroll tax to pay for it, even if you balance the two, would benefit the economy?
I don't want to comment on specific types of proposals of that nature, but I would be inclined, as I've indicated to you and to other members of this committee, to be focusing more on trying to restrain spending as a means of reducing the deficit than endeavoring to work on the tax side, because in my judgment it is very difficult over the long run to get budget deficits down from the tax side, because there is a tendency, as best I can judge the process, to tend to spend when one taxes, and it's far easier to get the deficit down, although politically far more difficult to implement if one works from the expenditure side.
Let me conclude by giving you a fairly broad question, but I think an important one. We have all here today second-guessed what you have done. I'd like to give you an opportunity, and I'd like to ask you, if you could dictate policy in the Congress, what could we do that would help put Americans back to work? If you could just tick off 2 or 3 things, what would you have us do?
Well, I would say, first of all, that what we must focus on is what, in my judgment, the American people are most concerned about. Not the next 6 months, perhaps not the next year or so, but they are very seriously concerned with valid reasons about the long-term future of this country. And any actions I would address in that regard would focus on that. And as far as government policy is concerned, as I've indicated on innumerable occasions before this committee and before other committees, that it is essential that we bring the budget deficit down as rapidly as we can, because it's a corrosive force which is doing very great damage to the American economy. It's diverting private savings from capital investment. It's created a situation in which the net capital stock increases, the stock of capital which creates productivity and standards of living in this country, is that rate of growth is slowing down very dramatically, and it is to a large extent the result of that deficit. So if we wish to create jobs and standards of living for the American people in the future and change the long-term outlook, it's in that area which I would be most focused.
Senator Graham of Florida.
Thank you, Mr. Chairman. In my opening statement, I suggested that what is happening today in our economy is significantly different than the assumptions upon which many of our computer models and expectation analysis have been predicated. That the kinds of initiatives, and it's not just lower interest rates, it's a historically weak dollar, it's unprecedented federal spending and budget deficits, all of which are classical Keynesian economics in terms of stimulative, and none of them have had the intended result, as witnessed by the economic performance during the 3.5 years of the Bush administration as compared to the economic performance exactly 20 years earlier during the Nixon administration. And so the question is, what is different in the economy today that's causing the prescriptions not to make the patient well? What's your analysis? What's your diagnosis of the principal changes that have occurred in the economy in the last 20 years? And then the next question is going to be, and what economic policies do you think we ought to take to reflect that change in our economic anatomy?
Senator, I believe that most of the analysis, not all, but most of the analysis which is involved in standard macroeconomic policy making as it has existed over the last 2 or 3 generations has focused on what we economists talk about as the income and product account, meaning the income statement, cash income received, expenditures, employment creation, and the like. Implicit in that evaluation is that the balance sheets of both households and businesses would not have a material impact on those decisions. And indeed, through a very significant part of the 1940s, 50s, 60s, and 70s, that was substantially the case. And I might add, well into the 1980s. That changed, and it changed basically because when borrowing reached the limits that it reached and the balance sheets reached the type of strain which they eventually achieved, the impacts on so-called income and product account relationships, to which I would relate on the side monetary policy, was quite considerable and unprecedented in any of our evaluations in previous decades. Therefore, the reason why I stated in my prepared statement that what we are looking at is a phenomenon that we have not seen for more than a half century is we haven't. I mean, this is the type of the type of economy which has many of the characteristics which we perceived prior to World War II, and some of the speculative imbalances and balance sheet effects which were not evident in the post-World War II period, in large part because we came out of World War II with an extremely high degree of liquidity. There was very little in the way of debt burdens. The levels of incomes relative to debt service remained very high for several decades. But eventually we ran the string, and eventually we ran up against the wall of restraint. And for the first time, we have seen such extraordinary things as declining money supply, declining loans, declining consumer credit. And that is a very unusual phenomenon, and the conceptual framework around which our general view of the way macroeconomic policy functioned has changed. And the same tools that we used in the past, which presupposed neutral balance sheets, are not working, or not working to the extent that one would have expected. They are working in part, but I think it's perfectly obvious that they're not working anywhere near as potently as they have in the past.
Well, if that's the fundamental difference, that is the change in the characteristics of the balance sheet and the importance that that's having both in our private and public lives, what do you think are the prescriptions for monetary policy and recommendations for fiscal policy that would address that issue? You've talked thus far about stimulating capital goods purchases, reducing federal budget to deficits as quickly as possible. Are there any other items that you would put on your prescription list?
Well, Senator, as I indicated in my prepared statement, the basis of Federal Reserve policy in recent years has been largely to confront this balance sheet problem, which manifested itself most evidently in the credit crunch starting in mid-1990, but has got a number of other characteristics associated with it which are all related, and until we have cleansed the balance sheet, getting back to more normal relationships, it's going to be very difficult to get the same effects at a fiscal and monetary policy that we got in the past. The impact, for example, of the monetary policies which we've initiated has created an extraordinary swing between short-term interest rates and long-term interest rates, by far historically unprecedented. But we consider that necessary to confront this particular type of problem, but it would surely not be an appropriate policy when balance sheets are back to normal.
Is there anything that monetary or fiscal policy could do during this process of cleaning up balance sheets to avoid the tremendous human cost that's currently being paid? Is there any way to make this transition less painful?
It is unquestionably an extremely painful transition, and one of the problems that we have with such transitions is to remember how we got to how we got here. And the way we got here is by, in large part, producing a budget deficit during periods of economic growth and prosperity and low unemployment, which made it pretty much inevitable that when we eventually, as indeed we would, get into a recession, we would have one of our major, or in fact not one of our major, our major policy tool of the past essentially impotent. Now, can we use it? The answer is yes, we can. The trouble, unfortunately, is it can only be done by trading off short-term benefits with long-term costs. That is a very major decision on the part of the Congress. It's not the type of thing which one does readily. I cannot say to you, I can say under no circumstances should one avoid such a trade-off, but it is a trade-off. We would, in effect, in my judgment, be undercutting some of the longer-term growth and stability of this economy were we to move in that direction. That is a very difficult choice to make. My own personal inclinations as a citizen, not as a policymaker, is I would choose not to do that. But that is a major value judgment that I think the Congress has to make in the name of the American people.
Senator Sasser, Chairman of the Budget Committee.
Thank you very much, Mr. Chairman. Dr. Greenspan, a moment ago, Senator Graham of Texas inquired of you about this constitutional amendment to balance the budget. You were wise enough to not get into that farcical political thicket. But of course, you and I know that that is something that would not go into effect if it were passed by the Congress and ratified by the states for at least 5 years. And we're talking about an economy that's in trouble right now. Further, Senator Graham asked you about, of Texas, asked you about curtailing entitlements. Well, now, you're not suggesting that in a time of economic weakness that we cut back on civil service retirement, military retirement, cut Social Security payments, reduce Medicare payments, reduce food stamps, reduce veterans' pensions, reduce railroad retirement payments. In the short term, that would have a deleterious effect on an economy that's already in trouble, would it not?
Well, Senator, I was responding to the longer-term issues.
I know you were responding
and I very
long-term,
purposefully
yeah. But what we're talking about now is trying to get an economy out of the ditch that's in it right now. We're not talking about getting it out 5 years from now.
No, but when I'm talking about the issue of balancing the budget, getting it back into balance, I'm not talking about the next year or so, and I'm not even talking in the context of 5 years, because I think that 5 years to solve the size of the deficit we have created would be very difficult to do. But if we don't get started on the process, I think we're going to be in very serious trouble. And I would be talking about evaluating spending priorities to go into effect sometime in the future, not in the immediate, not period immediately ahead.
All right, I understand.
Unless we do that, we're never going to get moving in the appropriate direction.
I just want to make the point that this business about passing a balanced budget amendment, which may go into effect in 5 years, and this proposal about cutting these entitlements, Social Security, Medicare, food stamps, veterans' pensions, civil service retirement, those types of things, that's not going to get us out of this ditch we're in the short term. Now, some of us urge this administration in January of 1989, when they first came into office, and the business cycle was still fairly robust, to do something about the deficit at that time. Now, they continued to fiddle while Rome burned, and now we find ourselves in the posture we're in today. We find that unemployment is up, and we've talked about that today. It's up to 7.8%. But industrial production is also down. Housing starts, both by way of starts and permits, that's also down. Exports are down. All of the indicators that you're looking at are indicating continued economic weakness. Now, Dr. Greenspan, a few moments ago, we talked about the importance of greater investment in plant and equipment. Now, just a few months ago, the Congress passed legislation that would have included investment incentives in the form of accelerated depreciation. If we had those investment incentives in place now, that would have included accelerated depreciation for capital expenditures in plant and equipment. Don't you think that the economy would be moving along stronger today than it is?
I suspect that capital investment would be somewhat higher, but government deficit probably would be somewhat higher as well as a consequence.
Well, the President vetoed that effort to try to get some capital investment moving.
Why would the deficit have been higher? The deficit, in fact, would have been lower because the package that was put together by the Congress and sent to the President.
I was responding very specifically to that. I mean, I would say...
No, but the thing that Senator Sasser was talking about was in a package that was not only deficit neutral, but in fact provided a little plus on reducing the deficit side.
So, Senator, I was only responding to the question of whether accelerated depreciation would affect the level of capital investment, which I think it probably would, but I also do think that it probably would have caused some reduction in corporate taxes, which would not have been made up by the aggregate increase in economic activity which would have occurred.
No, Mr. Chairman. You let it into the deficit question, and the item which Senator Sasser made reference to was contained in legislation.
Well, then I misheard him.
which had other provisions in it that not only provided to be deficit neutral, but in fact picked up a little bit to address the deficit.
Well, I misheard him.
Isn't that, I asked my colleague, isn't that correct?
That's correct, yeah. Mr. Chairman, I very much appreciate Senator Sarbanes' inserts here, and they are very worthwhile. However, could they not count against my time?
Am I next in line? Yes. Well, I yield some of my time.
Mr. Chairman, as you know, I've long been a proponent of lower interest rates, and you and I have kicked this around since you have been chairman of the Federal Reserve Board and even talked about it in your first confirmation hearing, and I believe lower interest rates are a tool to spurring economic growth. I was pleased when the Fed began reducing rates. As I said earlier, I think they came too late, and as Dr. Tobin said, too little too late, but at least at long last the Fed began lowering rates. Now, in this atmosphere of falling rates, I'm struck by the fact that rates on savings instruments are falling faster than those on loans. In other words, my mother's CD in the bank, her rates are just going down like that. But the fellow that goes to the bank to borrow some money, his rates are not going down that precipitously. In other words, the way the Fed's interest rate policy is filtered down, it appears to be working principally to the detriment of savers and not inuring as positively to those who are lenders. Now, I would cite as evidence of this, and I'm following up on something Senator D'Amato said earlier, I would cite as evidence of this the average 6-month bank certificate of deposit was paying 6 1/4 a year ago. It's now paying 3.97, a decline of 2.28 percentage points. But the rate for a fixed rate mortgage has fallen only 1.5 percentage points to 8.12%. This is the average. Now here's what I'm coming to. According to the press, these low interest rates help banks earn a record $7.6 billion during the first 3 months of the year, compared with $5.5 billion in the first quarter of '91 and $3.1 billion a year ago. The American Banker, the organ of the banking or a very authoritative publication dealing with the banking industry, reported last week that banks in almost all regions of the country have increased their second quarter profits, and I quote, sharply, close quote. Now my question is this: are banks using the opportunity of the drop in rates simply to increase their profit spreads, which I suspect they're doing, instead of making the loans necessary to get this economic recovery going? I'm hearing from business people in my state, and particularly small business people, they're having great difficulty still getting loans, that there is a credit crisis out there, yet we see the banks' profits up sharply. What's your response to that?
Well, I think, first of all, that your factual statements, I think, are quite correct. That is that interest margins of banks have opened up, and one of the basic reasons that they have done so is largely to restore their capital positions. There was very great concern in the banking community a couple of years ago that the combination of sovereign lending, LDC lending generally, and the commercial real estate problems which hit the banks was going to create a major difficulty for the commercial banking industry. One of the reasons I might say that we moved interest rates down for short-term bank-type funding instruments considerably was an endeavor to try to assist them in increasing their capital position, as indeed was the reason for 2 reductions in reserve requirements. So in that respect, what we perceived of is a necessary policy response to try to restore a viable commercial banking system, which in many people's judgment, not only our own, was in some difficulty. There has been a major improvement in banking since, but there is still considerable concerns which are a carryover from the lending problems that occurred in earlier quarters, which has tended to pull back, tended bankers to pull back, and the way they pull back is to open up their margins. In other words, what they do is they offer less to depositors since they don't want the money, and they charge more to lenders as a means of trying to improve their capital position. Well, the consequence of this, obviously, is to create a significant slowing down in lending, which is what we have perceived. It tends to create a considerable concern on the part of numbers of people who are holding bank deposits and whose income has come down very dramatically. And it's one of the reasons why a number of people have decided, granted the difference between the costs of borrowing, whether it's mortgage or whether it's consumer installment credit, and the difference of what they can get on their deposits, to use the deposits to pay off the debt. And that's one of the reasons why money supply, incidentally, has behaved so sluggishly as it has. We have been concerned about the same issue that you raised, Senator. What are you doing about it, Mr. Well, what we're trying to do is to trying to encourage a restoration of the capital position so that the banks are no longer concerned about that. And as I indicated to Senator Cranston earlier, we are looking very closely at the leverage ratio, which was imposed as a necessary concomitant to the risk-based capital requirements which are being imposed worldwide to substitute for interest rate, so-called interest rate risk. But now that we are in the process of getting interest rate risk embodied into the overall risk-based capital policy, I believe that we will fairly quickly be able to dispense with the leverage ratio. And in my judgment, although I must say to you there are disputes within the Federal Reserve and elsewhere about this issue, in my judgment, that should be a significant factor in easing up on what is still a credit crunch. We still have significant reluctance on the part of a number of commercial banks to make business loans. And since that means largely small and medium-sized businesses, that is a significant problem because that's their major source of financing. But we do have in a number of our surveys indications that that process is beginning to ease, and that there are significant hints that the lending to smaller businesses is beginning to evolve. The National Federation of Small Business, if I get the title correctly, which I'm sure I didn't, I think it's Independent Business, show a somewhat less constrained evidence of this problem, but it still exists. It has not gone away.
Here's my concern. I'll say this, and then I'll yield to my colleague from Maryland. Here's my concern. We're reducing interest rates, and the banks are using these reduced rates and taking this to cut the return that they give savers who save in their banks. They in turn then take funds and invest them in long-term government securities. And we now find that the banks, in my view, are getting well from their ill-advised leveraged buyout policies and loan policies of the 1980s, simply by squeezing the mom or pop who has the CD and taking the funds that they get from the Fed at a low rate and then investing them in long-term government bonds. So in effect, the taxpayers are bailing out the banks from their problem loans of the 1980s, it appears to me, and the CD holders are helping pay the freight on it.
Well,
isn't it true that banks now are the largest purchaser of U.S. government securities?
yes, they're very significant purchases.
That is a phenomenon that's occurred just over the past 6 months, isn't it?
Well, no, it's a little longer than that. I think it's over a year. But I think the crucial question here is whether, in fact, that particular process is a major factor in the loan restraint. What we have done, as I think I indicated in a letter to the chairman at one point, is to try to disaggregate various different types of banking institutions by the extent to which they are well capitalized, on the grounds that the undercapitalized banks would be tending to go in the direction of not lending and buying government securities as a means, as you put it, of getting well. What we found on that analysis is that the extent of increase in holdings of U.S. government securities was fairly broad across all of the various different capital positions, meaning highly capitalized banks were also very heavy purchasers of government securities, which suggests that the major, not the sole, but the major reason for that accumulation is basically a lack of loan demand. In other words, as we pump reserves into the commercial banking system, they either have got to lend it or they've got to put it in securities because we've pumped up the system. But from what we can evaluate, while I still think there is an element of credit crunch involved in a number of institutions, by far the largest part of the motive for accumulating the securities is a lack of loan demand rather than an endeavor to invest in government bonds as distinct from making loans.
Well, how do you square that? Go ahead. How do you square that with the repeated stories we're hearing from people on Main Street who say we can't get loans from the banks for credit-worthy projects? I mean, and these are people, you know, who've been in established business activity and who now find their access to credit crunched. And it really raises the question whether I mean, you're trying to push this monetary ease out there, but whether when it finally gets out there, it's not simply being, in a sense, diverted in the way Senator Sasser has outlined, rather than being used in order to stimulate economic activity.
Yeah, no, Senator, I think it is both. I think that the type of anecdotal evidence that you pick up and we pick up, I think is largely correct. I think that these are not stories that are made up by people who've got grudges or something like that. I think it's a substantially valid concern. I'm saying, however, that I don't think you can explain the whole huge increase in government securities by that, because we have other evidence to indicate a substantial part of that is lack of loan demand itself.
Let me just say, Senator Kerry, you were next in the order. You had to leave to preside, and I think between us, we've worked out arrangements so you come back, and you're actually next in the order, and I think I need to call on you and then go to Senator Sarbanes.
Thank you very much, Mr. Chairman. With respect to this issue of the Fed on the level of the real interest rates and the long-term rates, is the Fed considering buying in order to lower the interest rates or force them down, buying long-term?
Well, Senator, we did engage in some of that. The problem that we have, and indeed I suspect it's the reason why the Treasury has refrained from doing more than modest curtailment of their offering of long-term securities, is that the evidence of what the effect would be is not very persuasive. In short, if, and this is an extreme statement, if all of the abnormal high level of long-term rates is inflation expectation, meaning that essentially no one will buy a long-term bond unless he gets at least a premium over his expectation of inflation, then the price of long-term bonds and the level of interest rates will have nothing to do on how much is supplied. And it's that phenomenon which watered down, which is what concerns people at the Treasury and the Fed in these actions. In other words, our view is that it might do some good, but it's very likely to be quite de minimis. And indeed, we moved forward to do a couple of these types of what we call coupon passes, largely because we have a declining maturity schedule in our Federal Reserve government portfolio, which we're in the process of trying to flatten out, and in the process are moving in the direction of buying some more coupons. But we're not engaged in a massive endeavor because there is no evidence of which we are aware that it will work in any appreciable manner. So that until we would find such evidence, and I assure you that were the evidence there, the Treasury would be engaged in this operation because their actions would be far more formidable in affecting interest rates than ours.
What evidence do you have then, in following up on Senator Sasser's line of inquiry, that the banks aren't just relying on that spread as a quick means of gaining this profitability that they've gained in recent time and increasing their assets and so forth, but they're not lending? I mean, are you saying then that the lack of demand is exclusively business-oriented, or is it more a reflection of the lack of confidence, or is it a reflection of the fact that the loan officers themselves are looking at the economy and saying, well, I don't see any prospect that I'm going to get the rent on my money, so we're not going to lend? I mean,
I think it's all of the above. I think that, first of all, I mean, obviously you have to ask yourself, if you're a banker.
Okay, well, let's assume, let me just go down the line here. Assume it is all of the above. And I think there is an ingredient of all of the above in there. And you have acknowledged that you're not going to break the cycle with the monetary policy. I mean, you can't go much lower than you are today, correct?
Well, I just assume not comment one way or the other on that, because that's that will be suggesting policies which we have not yet defined at this point.
Well, it's an all-time low for 29 years.
I will grant you that interest rates are very low.
Now, you say also that you see signs, and you've referred to this a number of times in the testimony this morning, that the structural change is taking place. What are the specific signs that the structural change is working its way out? And you said also that we're at the halfway mark. Now, depending on where you begin to measure, I certainly can measure 2 or 3 years of this workout. Does that mean we have 2 or 3 years from the halfway mark we're now at for these signs you're talking about to really become evident?
I would say that it's, about halfway on the broadest measures of balance sheet stress that we have for households. I'd say a good deal more than that for the business sector. It doesn't, however, follow that you have to go completely back to where we were before you begin to get a freeing up of spending. Because as I indicated in my prepared remarks, I believe that as we begin to continue to improve the grasp, the tightness that the balance sheets have induced on consumer and business behavior start to relax. They don't fully remove themselves until we get back to whether it's a year and a half, 2 years, I don't know. But well before then, you begin to get the relaxation occurring. It just does not go to 100% until the system.
But the relaxation you're referring to is really going to have to come from a change in confidence, and the change of confidence is going to have to come from some kind of perceptible demarcation points, i.e. the leading indicators, the plant and equipment investment, R&D. I mean, something's got to shift here.
No, I would say that you can get confidence, in part at least, merely from the improvement of the individual balance sheets. In other words, people who have overborrowed, businesses who have overborrowed and have been saddled with fairly heavy interest and debt service payments, when the value of their house has stopped going up or gone down, or the value of commercial property has gone down and you are stuck with that debt, it's only when that debt is paid down significantly, where that is no longer an issue, that one feels more comfortable in going out and spending or investing. Okay. And I would say that very process itself is going to be the most important in obtaining a cleansing of balance sheets and a restoration of confidence. Now, implicit in there, I will certainly grant, is that employment growth is not irrelevant to this. I mean, the stagnant employment growth that we have seen has been a factor which has prevented a more rapid resolution of the balance sheet problem. But even with the stagnant growth that we've had, there has been a significant balance sheet resolution, and it's continuing. And that, from an individual's point of view, is far more apt to restore individual confidence than any broad measure of leading indicators or anything that people see. I don't think that people basically engage in spending or investing on the basis of what they read necessarily in the newspapers. They are mainly involved in their own personal financial status. I would guess that a substantial part of how people behave depends on their own sense of what their status is, as distinct from what they view the economy as a whole.
I know the light is on and my time is up, but would not that sense of status change dramatically nationally with some investment from which most people agree you get a different return than your traditional government spending of either entitlements or defense spending, but rather capital investment that most states separate in their budgets, and we do not nationally, and we greatly handicap ourselves. I mean, would not 10 billion, 20 billion, 30 billion of investment in that kind of infrastructure greatly enhance that status outlook that you've referred to, sufficient to kick in a lot of the transition and the structural change?
Well, Senator, I'd be more inclined to believe that while many economists have and will continue to view productive investment as adding to the productive capability of the economy, I would be doubtful that the average individual pays all that much attention to that when it reflects what he or she is going to spend on, or how
But
he or
this
she
is their
is gonna
neighbor,
behave.
Mr. Chairman. You're
Sure,
talking
no,
about their neighbor on their street, and when you walk down the homes of America and 1 out of every 10 people in the street is unemployed, and they see more people losing their jobs, and they don't see it turning around,
Oh, no, if you
they
ask me
tend
about
not
it,
to
yes,
go out
no,
and feel
sure.
confidence and spend,
Oh,
do
no,
they
if you
not?
ask me, is the issue of the degree, well, let me be very explicit. I would say the layoff rate is a crucial element in consumers' confidence. It's not so much the level of unemployment, it's the extent to which people are losing jobs, because that is the issue which concerns most people. If they are employed, the unemployment rate itself doesn't give them any signals about whether or not their job security is high or low. But if the layoff rate is high, meaning the unemployment rate is rising, then I would say that has a significant effect on consumer confidence.
Isn't that precisely what we have?
I would say that we've had part of that, yes, but I think that we have more than that. I think that, as I've indicated in the past, I think there is a very deep-seated concern, not about the next year or the next 2 years, but about the broader future, and that, I think, is where a very substantial part of the sense of distress that the average American has had in recent years comes from.
Senator Sarbanes, the chairman of the Joint Economic Committee.
I just would follow up Senator Kerry's question with the observation that in this recession, the percentage of people losing their jobs who are being permanently terminated as opposed to being laid off to be called back when economic activity picks up has shifted markedly. And what's happening now is people are, they're not being laid off and told, well, economic conditions have slowed down, but when they strengthen again, you'll come back to work. They're being given a pink slip, and that's the end of it. There's no job there whether economic conditions pick up or not. They have to start out then on a whole new career path in order to try to find a job, and I think that's having a very sharp impact on people's outlook about the future.
Well, I think that you're quite correct, Senator, in the sense that the proportion of job losers to job layoffs has gone up appreciably. But I do think that if you take a look at the ratio of job losers to employment, while it's clearly gone up, it's still very significantly below where it was, for example, in 1982. And even my recollection, looking at those data, is that it's about where it was back in 1984, 1983.
Well, of course, 82 was the worst recession since the 1930s, since the Great Depression. I mean, the unemployment rate went to just under 11%. I mean, 7.8% now. It went to 11% then.
No, what I'm trying to say is that while it is certainly the case, and I think you're quite right in addressing this issue, that the composition of job loss has changed, that the absolute level is still not in record territory or even remotely close to it.
Well, I'm going to get to that because I want to spend some time on the recovery of jobs in this recession compared with other recessions. Before I do that, though, I want to clear off the agenda what I regard as I hope it's just a housekeeping item. If it's not, then I have some very serious concerns about what's going on down at the Fed. In 1989, the Fed did a survey of consumer finances. This survey obtains information from households about their income, assets, and liabilities. In a hearing in September of 1990, I asked about the data from this survey and indicated an interest, this was at a Joint Economic Committee hearing, in having that data available in order to be able to analyze it. You then indicated, quote, it will take another year before those data are readily available. And we kept in constant touch with the Fed staff throughout the balance of 1990 and into 1991, and then as we got into 1991, it was indicated to us by Fed staff that the release of the data was a few months away. Finally, in March of 1992, the Fed made available a preliminary data tape, but it was missing from it were about 10% of the cases. And we think perhaps the most significant ones, because they were apparently the ones at the upper end of the scale if you're going to try to analyze the import of this data. I raised this issue with you again at a hearing on April 17th about getting this data. There was also apparently pending a study that the Fed itself had done, an in-house study about the data and what it showed. And you did shortly, you said that that hearing that you had something in your inbox, you'd make it available soon, and shortly thereafter you did release the in-house study. But we've not yet obtained the full data. Now, the Fed staff indicated that it would be available, this was back in April when a discussion was held with them, in a couple of months. Well, more than a couple of months have passed. We've not yet gotten the full set of data. We're very anxious to have that data available. I'm sort of at a loss to understand why it's so difficult.
Well,
I don't want to move to a sort of position of wondering what's going on here. Why can't we get this data? And I hope that it's simply some kind of bureaucratic problem, and I would just ask you to take any steps that are necessary in order to assure that the balance of this data, which would make the preliminary data tape provided in March a complete data tape, be furnished promptly.
I frankly had thought that had been completed at this stage, because there was a processing problem with respect to IRS tapes and the individual names on some of that stuff, which I thought was what the problem was. I thought it's been resolved.
Well,
can somebody, don't just sit there and nod your head no. I mean, we got telephones in the back room. I'd like to get an answer before we clear out of here today as to what the problem is when we're going to have it. Now,
let me say this. There's absolutely no reason that I know of why those data should not be made available to you sooner rather than later. And if there is a reason that is holding it up, which we can change, I will see that it gets changed.
Well, I appreciate that very much, and I do want to say, Mr. Chairman, that you personally have been responsive in the manner you've just indicated consistently throughout, but when we try to come out of these sessions and then carry it through, we seem to run into some difficulty. So if you could...
I will try to see whether I can get this resolved as expeditiously as possible.
We appreciate that very much. Now, I want to address this issue of what I now call a jobs recession. And I really want to get your view as to what's going on. This is a changes in payroll employment from the cyclical peak, percent change. And this line here represents the average of 6 previous recessions. And this line represents the current recession. Now, what this shows is that in all of the current recession and the average of the 6 previous recessions, starting from the cyclical peak, you obviously had job loss as you move into the recession. I mean, that's in part the definition of a recession. And you came down here, and you get here, these are the number of months from the peak, in other words, when you started downwards. And we hit a point down here about, this is 12, 14 months after the peak, and then you started back up in these previous recessions, the average, and so at 22 months out here, they had more than recovered the jobs that had been lost. More than recovered them. In this recession, that hasn't happened. I mean, here we are 2 years after, almost 2 years after the peak, And we're tailing along here in terms of job recovery. I mean, the contrast between what's happening here and what happened in previous recessions, where this represents job recovery, is absolutely striking. I mean, it's a complete deviation from the previous pattern. In fact, we asked the Bureau of Labor Statistics when they were before us for the last hearing, they were keeping it a somewhat different way. They said this was the percent of lost jobs recovered after 14 months from the trough. In other words, they were measuring it from the trough, which they took to be about March of 1991. So you're coming out of the low point, out of here, and in other words, they were measuring it from here. You come out of here and move up. So I asked them, if you want to talk about percent of lost jobs recovered after 14 months, the percentages are all over 100%. You have more than recovered the jobs lost and in fact begun to grow. And I said, well, why don't you give us the figures for the other recessions? He said, would you like me to do each of the recessions? I said, if you would, please. Now just listen to this. So they took the first recession after the war. They said the trough was October of 1949. In other words, down here. After 14 months, they'd recovered 174%. In other words, not only recovered the jobs lost, but more than recovered the jobs lost. Then they said the next recession, the trough was May 1954. It recovered 128%. April of 58, 132%. February of 61, after 14 months, 169%. In other words, the economy had come back, recovered all the jobs lost, and gone beyond that. Then November 1970, after 14 months, 244%. March 75 was the trough of the next recession. After 14 months, 191%. July of 80, after 14 months, 151%. November of 82, after 14 months, the percent of lost jobs recovered is 139%. And I said, what is it in this recession? 9%. 9%. Now, in every one of these previous recessions, the lowest figure for any of them, 14 months after the trough, was 128%. And in one instance, it had gone as high as 244%. Now, in this recession, it's only 9%.
After 14 months after the trough.
Exactly. 14 months after the trough, we're still down here. We've only recovered 9% of the jobs. In every previous recession, the lowest figure was 128% of the jobs had been recovered, and then it went on up from there to as high as 244%. Now, this is a dramatic contrast. Absolutely dramatic in my view. Now, either, you know, it's wrong to put the trough where people are putting it. I mean, the President of the United States, 2 successive months, told us in the days just before the unemployment figure came out that the economy was getting better, but the American people didn't realize it. And then the unemployment rate jumped 0.3 of a point. The next month he said roughly the same sort of thing, and the unemployment rate jumped another 0.3 of a point to go to 7.8%, the highest in this recession and the highest since March of 1984. The American people know that something is wrong with the economy, but the President doesn't seem to understand it. Now, what's happening?
I think there are several elements of explanation. First and most important, obviously, is that the extent of cyclical recovery in this particular period, 14 months after the cyclical low, is very substantially less. I mean, it's also the recession basically was shallower than most, and one would expect that the recovery would be less, but it's been even less than one would expect on the basis of the degree of shallowness.
What is the growth?
What is confirming what he just said?
Well, no, I'm talking about economic. I'll get. You'll see what where I'm getting.
What is the growth rate of the economy generally coming out of previous recessions?
Depends on how deep the recession was, largely. But on average, we've had much deeper recessions and have had 4 to 6% or more in quarterly growth in the early quarters of a recovery.
Now, we've had 2% growth in the last quarter.
You mean, are we talking about the second quarter?
Yeah.
It's probably somewhere in that area.
And that's the first quarter since the first quarter of 1989 that we've had 2% growth. Is that correct?
No, the first quarter we had 2.7.
All right, these 2 quarters are the first time we've had 2% growth since 1989. Is that right?
Yeah.
And the 2% growth figure is a very low figure compared with previous recessions in terms of coming out of the recession. I think the lowest previously was, what, 3.8% or something of that magnitude of the previous recessions?
That would sound to me approximately correct, yes. Let me go on. I think that what we've got here, first of all, is that the major reason is the same reason that the economy in growth, not employment, is moved up slowly. But productivity is also picked up, which has obviously meant that with any level of economic growth, you need fewer people. And as a consequence, the productivity growth has also been a factor here.
But let me just stop you there. To what extent is the improvement in productivity the fact that workers are being gotten rid of, and so the output is up per worker because there are workers being thrown out the side door?
That's a measurement problem. To the extent that you get increased output per work hour merely by laying people off who weren't doing anything, that's a phony statistic. I'm saying leave the statistics aside. I would say whatever evidence that we have got, establishment by establishment, company by company, is that real productivity has been improving, and that would mean that if you were to let people go, you get lower production. I would just say, finally, there's another problem here, which is basically that our long-term growth has slowed down. And as a consequence, since we're looking at the extent to which people come out of recovery in the earlier periods, because you had a higher growth rate, you were going to be getting a pickup in the overall trend, so that when you come out of a recession, to get to a new higher level, it adds to the growth. And finally, just let me say that I suspect, although I do not know for sure, that we're likely to get some modest upward revision in those data. I think we have some evidence which suggests that, but that's not going to change the configuration that you're talking about. That gap will exist, and the fundamental reason for that gap is the issue of growth and gross domestic product, which is subnormal.
Well, now you spoke earlier about, on the unemployment figure, that you had an unanticipated surge in the size of the labor force. Now, are you making that observation in the context of the fact for over a year people were commenting about that the growth in the labor force was far less than they had expected?
I'm sorry, would you just repeat that again for me, Senator?
Are you making the observation that recently there's been an unexpected surge in the growth of the labor force?
In the published data.
In the context of the fact that for a year, more than a year, we'd been worried up until the last few months that the labor force was growing far less than anyone had expected.
That's correct.
So you're comparing it against this very slow growth in the labor force. But that's really moving the situation back towards normal. The abnormal situation was the slow growth in the labor force which we were experiencing, which suggested that a lot of people were so discouraged by the economic news that they simply dropped out of the market. Then they begin to think, well, maybe things are getting better. They come flooding back in, looking for jobs, and your unemployment rate. But the abnormality is not the number now looking for jobs. The abnormality were the people who had become so discouraged they dropped out of the labor force.
Yeah, let me say, looking at those data, both the contraction and the expansion, I just don't find it credible that it's unmeasured discouraged workers that are involved there. Those numbers are just too large. I don't know what the answer is, but it's probably not a crucial factor in the employment data as such, as far as at least I can judge. When we're looking here at basic growth in the economy, which is slow, I mean, I suspect, for example, that the first half is, quite dull. I don't. All I know at the moment is that the 2.7% increase in the first quarter probably in part reflected abnormal adjustments in seasonals, and that the real underlying rate was probably closer but not all the way back to 2%. And I don't know what the second quarter number is going to be. We don't have enough data.
Are you saying the first quarter number probably is going to be revised downward?
I don't think it's going to be revised down. Basically, what I'm saying is that the weather in the first quarter was more conducive to economic activity than the formal seasonal adjustment factors employed capture, so that we get, for example, the weather was much better in January and February, and therefore much more housing construction than it normally is the case in the winter months. Those numbers embody themselves in the GNP accounts, and that's what we're publishing. So that, for example, if and I don't know the answer, if, for example, the figure for the second quarter is published at 2% or slightly less, what that is basically saying is that we borrowed some of the second quarter from the first quarter in the seasonal because of the seasonal adjustment factors. And I would be inclined to look at this pattern as somewhat of an average of the two, which is in the context of the rising productivity, even after you adjust for the labor force growth, barely adequate to keep the unemployment rate changed, because we do know that the employment to population rate remained unchanged.
Mr. Chairman, I know my time has expired, and I just close with this observation, and that is simply to say that Dr. Greenspan's attitude towards this economic situation is in tandem with and consistent with the administration's attitude, in the sense that it's sort of no problem. I mean, we're sitting here trying to deal with unemployment that has risen sharply. It's now at its highest figure in over 8 years. And we're sort of being told, well, there's this and there's that, there's really no problem. It's like the president who says, the economy is getting better and the American people don't know it. The fact of the matter is the American people know exactly what's happening, and they know there's a lot of economic trouble out there.
Well, I would say,
but we keep trying to sound this alarm that there's a problem, and the response we're getting when you finally cut through it all is sort of, well, no problem, no problem. I don't agree with that. I think there is a problem, and I think it's a problem that needs to be addressed on many fronts. But it's difficult to do it when the administration refuses to recognize a problem, and when the Fed sort of, in effect, says, stay the course. I mean, it's the same sort of quotes we were getting from you back in last year and in February.
If I might, just, remember we have used the major tool at our disposal 23 times since mid-1989. We've lowered reserve requirements twice. We have engaged in what has to be historically one of those extraordinary periods of economic ease. Clearly, we wouldn't have engaged in anything remotely like that if we did not have concern about the nature of the economy
Well,
and
Senator
the problems.
D'Amato was right on that point. You're always after the fact. You're always trailing the economic developments. We had both Samuelson and Tobin here with Senator Sasser and I chaired a hearing back in January.
If I might correct my colleague, I said that before Senator D'Amato said it.
That's absolutely correct. We had Tobin and Samuelson, two Nobel Prize-winning economists, who came in here and said the Fed is too little and too late, that there's not this large inflation ogre, and that they ought to be moving to try to stimulate the economy and be moving sooner than they're doing, particularly at a time when fiscal policy has been, to a large degree, immobilized. Your response in this recession, in terms of easing monetary policy, until your December action, was significantly less than what the Fed had done in previous recessions, even though in those previous recessions, fiscal policy was also acting in an effort to try to address the recession. And it wasn't until the December action that you got anywhere near the average of previous Fed action and the extent to which you eased policy. And we find ourselves in the situation in which we find ourselves. Well, thank you, Mr. Chairman.
It seems to me that's the problem. The strategy really hasn't worked, and there's not enough of it, frankly. I think the record will show that when you commented on how the numbers for the first half will look after these adjustments that will be made for seasonal factors and so forth, that the economy is not showing any real spurt of growth. I think you used the word dull, D-U-L-L, to describe it. I think that's the word I heard you use. Is that right?
I think so.
Let me ask you this. Is unemployment apt to go to 8%?
Is it?
Yes.
I really don't know. I certainly hope not.
Well, I hope not, too, but I'm asking, you know, you're a forecaster, and, you know, we're asking you to look ahead here. Do you think it's likely to? It looks to me like it's going that way. I'd like you to tell me that you disagree with that and you think that we've hit the high point on unemployment.
Well, no, but let me tell you what I know. I mean, what I know at the moment is industrial production in July seems to be somewhat higher, at least as far as we can judge from weekly data. We do know that there is a level of orders coming in which is not consistent with continued deterioration, although it's by no means robust at all. What we have very little capability of doing is projecting the labor force.
Did you project an unemployment rate earlier the year for the end of 1992?
In February, yes, we did.
What did you project that rate to be?
6 3/4 to 7%.
6 3/4 to 7%?
Yes.
Now, that was as a year-end number?
It was a year-end, that's the average, year-end number, of average for the fourth quarter. It's average for the fourth quarter of 1992.
Well,
what was the unemployment rate when you made that projection?
Yeah, this would be in January.
January, February
7th. 7.1.
7.1 in January.
Yeah, the unemployment rate was 7.1, I think, when we made the estimate.
It's now 7.8. Have you revised that number?
Oh, yes, we have.
Have you revised? I mean, what's your revised number now for the year-end number look like? Is it still 6 3/4 to 7?
No, it's 7 1/4 to 7 1/2.
You now think it's going to be between 7 1/4 and 7 1/2?
This is the central tendency of the individual forecasts of the FOMC members and the non-member reserve presidents.
You're saying that's their number and not your number?
Well, I didn't make a specific forecast. I have not actually myself made a
let me tell you what I feel out there. Let me tell you what I feel happening, and not just in my state of Michigan, but across the country. We could talk the rest of the day about the data because there's a lot of bad news out there. I wish there were not so much bad news, but that's what we're having. And I feel the economy continuing to slip on us. And I think unemployment is going to continue to go up. We continue to get these large announcements of permanent job eliminations by major companies. GM just the other day on white-collar employees, but it's one company right after the other, Alcoa. There's almost no major American company that's not on the list right now. So it looks to me as if unemployment's has a very good chance of going above 8%. Would you dispute that? Do you think that's something that could easily happen here?
I really don't know. It depends very much on the labor force growth projections, and I'm at the moment very uncomfortable with the data, and I would like to hesitate because I just don't feel comfortable.
Let me give you a clue as to why I think you're seeing this strange action in the labor force data where more and more people are seeking work than historical data might suggest.
No, Mr. Chairman,
let me just say, people are hurting. I mean, people need income. That chart I showed you earlier about per capita income falling, that's what people do when they need money they don't have. They seek work. And we got all these people seeking work and not enough work to be found. And I don't know how to get that message in from where people live up through the levels of analysis to the Federal Reserve Board. I don't think the message is getting through up there. Now, you may be able to tell me that you're hearing it, but I'm not. If you're hearing it, I don't see it coming out in the policies. I don't even hear it coming out in the statements that are being made today. I read that opening statement very carefully, and I listened to you as you delivered it. I saw all the emphasis on inflation and the whole concern and the tilt of policy that way. I didn't hear very much about the very serious problem out there with unemployment and underemployment and the number of people who are struggling to try to make do with less disposable income. I'm not saying you can solve that problem all by yourself, but if you don't see that problem, and if that problem isn't accorded a very large part in the policy considerations, then I don't think things are going to change very much. I think unemployment is apt then to continue to go up.
I would say, Mr. Chairman, we are acutely aware of those data. We follow them very closely.
Well, I mean, I don't hear you talk about it much.
Mr. Chairman, let me just take this a step forward, because I don't want this hearing to leave the impression that this unemployment rate is due to some unusual growth in the labor force. Now, for months, Janet Norwood, who's now retired as Commissioner of Labor Statistics, came before the committee and testified on the unemployment rate, and in the context of the fact that the labor force was growing less than it was reasonable to anticipate it would grow on the basis of demographic projections and so forth and so on. And we, in fact, would say to her, well, if the labor force had grown as you expected it to grow, anticipated it to grow, what would the unemployment rate be? And the response was it would be about a point higher than it was. In other words, it was at 6.8, it would have been 7.8, but for some reason, the labor force wasn't growing the way it ought to grow on the basis of the projections. Now what has happened is that the labor force has, in fact, grown the way it ought to grow on the basis of the projections, and the unemployment rate has gone to 7.8%. But it's not an adequate answer to the question of why we're at 7.8% to say we've had an unexpected large growth in the labor force. We've had the growth in the labor force that, in fact, you expected. What was unusual is that earlier on the labor force wasn't growing the way it was expected to grow, and therefore the unemployment rate was understated. But you've got a 7.8% unemployment rate now on the basis of a labor force whose projections now meet what one would have anticipated would take place.
I agree with that, Senator. I think that...
okay, well, I want to be very clear about that.
No, I'm just saying that basically that we had that dip in the participation rate that Janet Norwood was talking about, and at that particular point, everyone was puzzled by it. The vast majority of forecasters that I know assumed that it would not go back to where it was, and the truth of the matter is it did. And that's the reason, in other words, the aberration, looking back historically, is the dip, not the recovery.
All right.
But I'm just talking about the rate of change.
What that means now is you got just under 10 million people out of work. You've got another 1.1 million who are so discouraged they're not looking for work. You've got 6 million people working part-time who want full-time work. That takes us up to 17 million people either totally or partially unemployed in this country today. I mean, the comprehensive unemployment rate is just under 11%. And yet, you know, we get this kind of, well, you know, it's all going to kind of work out somehow. It's not working out.
Let me try to make it as pointed as I can make it for you. The University of Michigan.
Sorry, Mr. Chairman, may I just request a 2-minute recess?
Of course. Of course. We'll take a brief recess and then we'll resume. Committee will resume, and we hope to finish shortly. It's been a long morning. There's a lot of ground to cover here, and so we want to finish our work and have our witness free to go as soon as we can here. I want to say to you again, so we don't lose track of the discussion we were having, I think there is a real risk that unemployment is going to go to 8% or higher. I just see too much slippage in the economy. I see too many job eliminations. An awful lot of people right now, highly qualified with advanced degrees in engineering, other fields, people coming out of college with advanced degrees can't find work. Look all over the place. I had a letter the other day from a man who's with advanced training and college degree, who's been through, if I recall from memory, he wrote the letter from Texas. He's been through 3 job retraining programs in different areas, still can't find a job as hard as he tries. I also think that we're running the risk that we could be very close to going into a third leg of this recession. And I want to tell you why I say that, in addition to what's been said here earlier this morning. The University of Michigan Index of Consumer Confidence was reported just a few days ago as having dropped in early July. And so you've got the question of how much did it drop, but also the fact that the trend is down rather than up. And it dropped from a figure of 80.4% in June back to 77.1% in early July. Now, there have been a number of other economic events come piling in on top of that, including the worst trade deficit numbers and a lot of other things. But if you take this national survey that's been referred to earlier, that has just been done by the Los Angeles Times, they just published this within the last week, and I just want to read you what they found in terms of going out and actually doing a scientific sample of consumer opinion across the country. And they lead, the headline on their story is economy. Back up. Confidence slides among consumers. Economy. A growing number now say the country is in a serious slump that won't end soon. Gloom underscores President Bush's political problems. Now let me just read you a little bit of the story. They lead out this way. A springtime rally in consumer confidence has petered out amid a barrage of bleak economic news, with growing numbers of Americans now saying the nation is in a serious slump, and optimism for a quick upturn is slipping, according to a new Los Angeles Times poll. The shift in public sentiment, which underscores President Bush's political problems and could foreshadow slower levels of consumer spending in the coming months, was apparent when people were asked their predictions for the near future. Just 19% expected an improving economy in the next 3 months, down from 28% in late March. Similarly, 42% now say the country is gripped by a serious recession, up from 35% in the spring. Overall, the poll portrays a public that is gloomier about the economy than most professional economists, who generally believe that a fragile recovery is in progress. Of those surveyed, 86% said a slump persists. And then it says, Mr. John, well, let me just read a couple of more paragraphs here. The new findings are, quote, consistent with the deterioration in economic activity that we've seen over the past 2 or 3 months, said Mr. Mark Zandi, an economist with Regional Financial Associates in Westchester, Pennsylvania. Quote, people are very concerned with their economic situations, and the future looks less bright today than in the spring when the economy seemed to be accelerating. John Brennan, director of the Times poll, said that the clearest message of the survey is that the public now expects more of the same bad economy rather than an upturn that was hinted at in the March poll. We had a little bright news last time, and now that's gone away, he said. And it tells how they did this survey, and it was done across the country and so forth. I only cite this. There are dozens like this that could be cited, and you're seeing them too. But as I talk to people across the country, you're about the most optimistic person I've talked to, quite frankly. I mean, you're more upbeat, and so I sort of say to myself, what is it that you're seeing that everybody else is missing? Or what is it that they're seeing that causes them to have a greater level of concern that you are missing or that the Fed is missing? And the sense that I have is that consumer confidence is now trending down again, and I think you've got some discrete measures of that from the University of Michigan, from this poll, and from some other things. And there's data that reinforces that. You can see why people would be holding this view in light of all of the weakness and the soft spots that are out there. And I'm asking you again now, and I want as frank an answer as you can give me, is there any risk here that we could go into a third leg of this recession?
Well, Mr. Chairman, I think, first of all, let's define what we mean by that. I would take the notion of a third leg of a recession to mean that the level of economic activity goes to new lows. And
well, I don't mean it that way. I mean that the growth that we've been seeing could now sputter out, stall, and we could start down again here, and that we could go to a lower level and perhaps even into a negative level.
Well, that's what I'm getting at. In other words, if you're talking about a question of lower growth as distinct from lower levels, every recovery has been characterized by rates of growth which have been unstable but positive. I would be quite surprised if we had a negative gross domestic product number in the foreseeable future. I would not be surprised that if we had ups and downs of the growth pattern.
So the growth rate,
in fact, the second quarter is going to be almost surely a lower growth rate than the first. Mm-hmm. Now, I wouldn't call that a dip. That's not alien to history. That occurs fairly often.
Well, it may not be. It's certainly not an encouraging sign, is it? I mean, wouldn't we like to see the growth rates increasing?
No, I would like to see the growth rate continue to rise quarter by quarter, but it almost never happens that way.
But you see, I think that perhaps there's a correlation between these two things. In other words, the fact that the second quarter data looks to be weaker than what we think we saw in the first quarter probably relates to what consumers are telling us, not just consumers, business people as well. But I think the signals are coming in from across the country that the problems seem to be getting worse and the outlook is not brightening, and people's are finding that they are less confident and that they are stepping back. And I think that means they're going to step back in their purchasing behavior and other things. In other words, I think these things probably are two ways of the same message being delivered. Now, let me hear your response to that.
Well, first of all, Mr. Chairman, the decline in the Michigan survey, which, as you point out, was about 3 points, is only a very small part of the recovery that has occurred in recent months. So, I mean, if one were to look at it on a chart, it's not as though one is getting a big rise and then fall. What you're getting is a significant rise and a small adjustment.
Yeah, but it's the trend line that concerns
Well,
me.
it's only 1 month. I will grant you that if it goes to 2 or 3 months, then that is a trend. But I would not consider it 1 month a trend. Secondly, we do have other evidence which suggests that the consumer is not all that discouraged. I mean, as you're acutely aware, motor vehicle sales have picked up. That is, we are getting...
Very modest.
Well...
a lot of fleet sales in that, too.
There are some fleet sales. I certainly acknowledge that. But even when one abstracts from the fleet sales, there has been a pickup in sales. Now, I'm not saying it's a boom. It is not a boom, but it's certainly consistent with some modest recovery. And indeed, the assembly schedules that have occurred as a consequence of that have been one of the bright spots in the industrial scene. That is, we are getting significant amount of statements that orders have picked up, and they attribute it to secondary suppliers of the motor vehicle industry, which is a not insignificant issue.
Is there anything more that you or the Fed can do to try to get some more strength into this economy at this point? Are you pretty well played out in terms of what's available to you to try to get more stimulus into the economy?
We are looking at the issue of, as I said, the leverage ratio and the capital controls issue, which I suspect would be helpful. We have looked at, and we continue to look at, the question which I discussed.
Have you tried jawboning the banks? Is it possible to ask the banks to take a look and see if they can't find some worthwhile borrowers out there that maybe they're not seeing now because the attraction of the fixed rate, no risk government securities is a little blinding to them?
Mr. Chairman, as you know, we have this regular survey of the senior loan officers of the banks, and they have indicated to us, and we take them at their word, that they have been seeking loans and been finding some, but not a great deal. In other words, there is a discrepancy between the judgments I hear, personally speaking to individual bankers, and what I hear to borrowers. I mean, you get a sense in which there is a communications
credibility. There's a credibility gap there somewhere.
There is a lack of awareness. Part of the problem, basically, is not difficult to understand. That is, a lot of loans were made in the last decade which shouldn't have been. A lot of people received loans who thought they were creditworthy, and therefore, if they were creditworthy in the past, they should be basically getting loans now. And what's happened is that there's been a far more conservative lending procedure on the part of loan officers, most of which I think is justified. And that creates a particular attitude which strikes a number of borrowers as being unresponsive. And I have a suspicion that there's probably a problem on both sides of that issue. I think that there are people who shouldn't be getting loans who think they should, but there's no question that there are people out there who are creditworthy who are not getting loans.
You know, it seems to me one of the things we have not talked about directly today is that the Fed has a sort of a built-in conflict of interest here, because you are one of the major bank regulators, and you're responsible for overseeing a number of banks in the country, keeping them healthy, making sure their capital positions are adequate, that they're not doing foolish things, loading up on too many commercial loans or whatever it happens to be. And the banks got into big trouble, not just the ones under your supervision, but the ones under the supervision of other regulators. And last year we had to pass legislation to provide a $70 billion taxpayer loan because the bank insurance fund was broke. Not the S&Ls now, but the commercial bank insurance fund was broke and at a deficit, the GAO tells us, at the end of last year. And I can see on the one hand, when you're managing monetary policy to try to increase the supply of money and credit to stimulate the economy, that on the other hand, you've got to keep a very close eye on bank balance sheets, because you're responsible for keeping your part of the banking system healthy. And I could see why you might be torn sometimes between actions that would help the banks and actions that they might take in their own behalf as they restore their tattered balance sheets versus a more aggressive push to get credit through the system to worthy borrowers to try to finance more of a lift in the economy generally. And we've had some conversation about it today, and I worry about how that inherent conflict may, in fact, be balanced at the present time. And I'm concerned that we may have a situation here where the banks are rebuilding their balance sheets, a lot of it by, as you say, this very substantial increase in their holdings of Treasury securities, risk-free. They can pick up the spreads that are out there. And yet, we continue to see the economy weak, languishing. We're certainly not recovering anything like we have in other previous recoveries. Senator Sarbanes points out we're well past, a trough point in this recession, and we still have not really come out of it with any strength. We have not regained the jobs. And I would hope that the Fed would not be voiceless in terms of speaking more aggressively about the need to get the economy going, and that banks, within the bounds of prudence and safety and soundness, I think, have to be more aggressive in trying to find the worthy loans, the good loans that small business people and others are attempting to get, that home borrowers are trying to get. We had a major problem with mortgage discrimination based on race, which your own Fed studies have shown us. One of the worst problems is out in Los Angeles, as a matter of fact, according to the data. A lot of creditworthy minority borrowers, Afro-American borrowers, want to borrow money to buy homes and to upgrade their homes, and they can't get the money because, in effect, they're being discriminated against in the borrowing process, which is outrageous, but it's going on. And your own studies show that.
I agree with that.
Well, but if you spoke about it, if you gave a major speech about it, if it was a major thing that you said and hammered, I suspect that we'd see more of those loans happening. And what that would do is not only solve the inherent unfairness of it, but it would get more of that credit out there to create jobs and give some additional lift to the cities that particularly that so badly need it. What I see it's like it's like looking with one eye, and it's like the one eye at the Fed sees the inflation problem and really has that in focus and has all of the concerns about how that relates to long-term interest rates and expectations and so forth and so on, but has a very hard time seeing out of this other eye in terms of the need to really get much more lift into this economy. And quite frankly, if the Fed can't do it, if you look at that problem and you say, look, we're played out, we've done what we can do, we've cut rates 23 times, and whether we were late or not, we've done about all we can do. And so don't expect us to be able to bolster this economy. You're going to have to look elsewhere. Well, if that is so, then it's important that you say that to us and not just sort of come back to us with sort of a reformulation of the old thinking that says, well, we've played out all of our tools and we don't really see any other tools. We don't see any other tools that don't create some inflation risk connected to it in some way, so we've just got to ride this thing out, no matter how grim it may get for people. I must say I have a very hard time accepting that, because I think it is first of all, I think it's the wrong strategy, but I think it's a very callous strategy. And I think people in government, I don't just aim this at you, I think it's a universal problem in government that gets big and gets remote, and that is that when people are being ground down out in the society, when working families are being ground down, when the middle class is being ground down, I think there's always a way to explain why it's necessary or why it may be good for them in the long run, or inflation control may require this. Meantime, people who've got to get from today to next week to next month to 6 months down the road are having a very, very difficult time doing it. People here in this town are getting by all right. They have health care, they've got pretty good salaries for the most part and so forth. It's not true out in the countryside. That's why you've got something of a political rebellion underway. And I don't know how to get the message through to the Fed. I mean, I don't think you're hearing it, because I don't see it coming back out of your testimony or your prepared statement today. I don't detect the urgency about this problem that the people are asking for. Now, you may say, well, don't understand. That's sort of what the president has been saying, is that things are better than the people think they are. If he believes that, you know, somebody really needs to sit him down and have a talk with him, because people know what's going on in their lives. And the anxiety that they're reflecting in these polls and this consumer survey data from Michigan is real. It's not will-o'-the-wisp. It's not something that people are inventing. People want to be optimistic. They want to be upbeat. The fact that they're not is because they see adverse and perverse things going on in their lives and around them. And we're not doing enough to fix it. And frankly, if the Fed has run out of tools that work, which is the way it looks to me at this point, then I think you've got an obligation to suggest the use of some additional tools that may be outside the scope of what the Fed can do. I don't think silence, you know, or just basically sort of saying, you know, let's just all take a deep breath and tough it out, I really don't think that's an adequate response to the problem. And I don't know how to budge you from where you are. We've asked you before. We've asked you orally. We've asked you in writing. And I don't know what it takes to put across a convincing case. I mean, we may have to just change the political leadership of the country. That may be what the public decides to do, because they're not satisfied. And they're not satisfied because the situation is just not what it should be. Let me just yield to my colleagues. I hope that we can cover this question of how your M2 rate has trailed now off in the last 3 months below even your own low side estimate. I also think before you leave today, we've got to find out what's happening in these currency markets and whether these steps taken yesterday are going to be anything more than just a short-term fix. Senator Sasser.
Thank you, Mr. Chairman. Dr. Greenspan, returning just a moment to a line of questioning that I pursued earlier relative to the banks purchasing long-term government securities. I mean, we have a situation here where the Fed discount, the discount rate's 3%. The federal fund rate is 3.25%. CDs average 3.9%. We've got a 6% prime rate, but the banks can get a return of 7.6% on government securities at no risk. And as a result, we've seen last year a 23% increase in the bank purchase of government securities, while concurrently, according to the Fed study, we've seen a 1% decline in bank loans. Now, I think it's highly desirable and most important that some disincentive be fashioned by the Fed to discourage banks from investing so substantially in federal securities at the present time. In other words, we need desperately to get this money out into the stream of commerce and get it out there trying to grow this economy. You spoke a moment ago of perhaps some tentative disincentives that you had been contemplating. Could you be more specific at this time?
Well, Senator, first let me say that there is risk if the banks were investing in long-term U.S. Treasuries, in the sense that interest rate risk could be quite considerable in the event that the markets turned against them and there was a significant rise in long-term rates and hence a decline in bond prices. As a consequence of that, the substantial part of what the banks hold are shorter term, where the yields are very much lower. The ability of banks to make money by taking deposits, CDs, and putting it into treasury bills or short-term notes is really quite limited. I would think that were they desirous of making money, the major way you do that is to go in the loan market.
Why are you putting so much money in the securities market?
Well, I think that the way they perceive it,
that there's no loan demand out there.
There's not enough loan demand. They have no alternatives but to put it there.
I'll tell you, Dr. Greenspan, that runs counter to what I what I'm seeing in my state and what I'm hearing from people. Now,
No, I'm not saying
hear
that that
what
is
you're
completely
saying, but
true. I'm saying that's a major explanation. It's not the full explanation.
right.
Well, has the Fed taken any steps? I mean, on the one hand, you talk to the bankers, they say there's no loan demand. On the other hand, you talk to the people on Main Street, and they say, well, we got plenty of loan demand. We can't get the loans out of the banks. Well, now, you know, there are two differing perceptions there. Has the Fed taken any steps to try to bring those into harmony?
What we have done in conjunction with our colleagues in the other regulatory agencies is to assume that there is a form of capital restraint, which is what the credit crunch basically is, and that's the major reason why people perceive they're not getting loans when they are presumably creditworthy. And what we have done basically is to try to find means by which we can soften that load, and we've taken a number of actions, which, as I indicated earlier, I hope will eventually lead, with a change in the leverage ratio, which will create a much less of a position of capital constraint, which is the source of the credit crunch to the extent that it still exists. My own impression, however, is that judging from the balance sheets of the borrowers, that the desire for loan demand is not there in any huge volume, and indeed what we find is that there is a very significant amount of corporate offerings made by especially the larger corporations, the proceeds of which are used to pay off bank debt. And that's been a material element in the general weakness of bank loan demand in the aggregated data, and of course it's been a factor in the money supply growth as well.
When did you last meet with the President to discuss the economic situation?
To discuss the banking situation?
No, the economic situation, the status of the economy.
I'd say several weeks ago.
Several weeks ago?
Yes.
And before, I mean, are you meeting with the President on a regular and consistent basis?
Not on a regular, I'd say periodically. I would meet with him and tell him what I think is happening.
So you don't feel there's a problem in terms of communication between you and the President? You're essentially on the same wavelength?
Well, it's hard for me to know whether or not I'm on the same wavelength, but I do try to communicate what I believe is happening to the President when he asks me to.
Dr. Greenspan, something you mentioned when you were before the committee before, and I want to go back to that. It appears to me that we're rapidly losing a sense of equity in income distribution in this country. There's an ever-increasing concentration of wealth with the top 1% of the population. And when you were asked about this phenomenon, when you appeared before the committee, I think at your last appearance, you responded that you were also concerned about this trend. Now, I think following your statement, the Federal Reserve participated in a study with the Internal Revenue Service, which did indeed prove that the rich are getting richer. And the study shows that the very rich dramatically increased their net worth during the 1980s. The wealthiest 1% of the population increased its share of private net worth from 31% in 1983 to 37% in 1989. The New York Times reported that by 1989, the top 1%, which represents about 840,000 households, was worth almost $1 trillion more than the 84 million people who comprise the bottom 90% of Americans. Now, you commented on the inequality in family incomes, and I think this has contributed to the feeling of pessimism about the economy in general. you testified a few months ago that you had never seen in your career, I'm just quoting generally now, not precisely, that you had never seen in your career the long-term, the pessimism about the long-term prospects of the economy that you see now. Now, I think that this redistribution of income that we're seeing here is contributing significantly to this long-term pessimism. How can we justify the fact that 1% of the richest people in this country reap the lion's share of the economic progress of the 1980s? What can we do about this trend? I know you're concerned about it. What would you suggest be done about it? I say this because I think this is an underlying factor in the pessimism affecting this economy.
Well, Senator, I think that from the income side, which I think also has an element involved on the wealth side, what we have observed is a significant spread that's opening up between returns to education and skill. I know it's certainly the case that the premium, or I should say the earnings of college-educated people has opened up, increased significantly relative to those who are high school graduates or dropouts, and that the income distribution is very clearly reflecting educational and skill capabilities. And this in turn seems to be related to the extraordinary change in the technological basis of output, or more exactly to what I like to call the conceptual basis, meaning that there is far greater and increasingly so over the years ideas as distinct from physical volume in the gross domestic product. It's reflected in the downsizing of computerized products and into a significant shift from bulk type of output to more conceptual, computer-related type of output. And this is a worldwide phenomenon. And what it tends to do is to put a significant premium on skills with respect to earnings, and I think that's very important for us to make sure that we...
Dr. Greenspan, I won't contest the fact that this may be a worldwide phenomenon. I don't know whether that's the case or not. I suspect it is. But this phenomenon is not, it doesn't impact in other countries the way it's impacting here.
I think that's probably correct.
And we're not seeing the great enrichment that's taking place at the top in other countries that we're seeing here. Now, bear in mind, we're talking about the top 1%. We're talking about 804,000 households in a country of, what, 280 million people now. Now, I frankly don't think that that can be fully explained away on the question, on the basis of just educational...
No, what I was saying is that you can explain a goodly part of the income distribution in this regard. I'm not sure, since I haven't really evaluated it from the wealth side, whether that is basically the case. But the point I was about to make is I think that the crucial element here is a judgment about our educational system and the need to make certain that we can convey the skills to the people in this society so that they can participate fully in the types of conceptual related output that seems to be in this long-term trend which is associated with increasing standards of living.
Well, I hear what you're saying, Dr. Greenspan. I'm not sure that I can totally accept that explanation. We're running out of time. Let me just ask you one other quick question. Now, last week, the German central bank raised its key interest rate from 8% to 8.75%. Now, this means that German short-term interest rates are now about 5.5% higher than comparable U.S. rates. Now, this huge interest rate gap is putting tremendous downward pressure on the dollar. Now, outside of Germany, the European economies are generally weak, and higher interest rates help push these countries into recession, but they're going to have to raise their interest rates to get into conformity with the Germans. Now, these higher German interest rates have put great pressure on the dollar, and the Fed has rushed into the breach in an effort to try to bolster the dollar, and were successful in shoring it up yesterday. But in the long run, in order to protect the dollar, I fear that the Fed is going to have to move off these low interest rate policies and entertain the idea of higher rates. Now, what's your reaction to that?
Well, Senator, I don't think I ought to comment on that, because that's...
Well, here's the point I'm making, Dr. Greenspan. I think you're running out of bullets over there at the Fed. In other words, you've cut the rates significantly. I think you've been behind the curve all the way, but you have cut the rates. We're not getting the reaction that we ought to get or that we expected. I think the banks are using these low rates to turn around and invest in government securities, get a safe return in that way. I don't think they're putting it out in the economy. I think you're running out of time at the Fed because the Germans are not cooperating with you. As their rates go up, they're putting pressure on the dollar, and I think at some juncture you may have to entertain raising your rates. You're running out of options, I think, Mr. Chairman, in monetary policy. And I think unless this economy turns around and turns around fast, and it's not going to do that, we're going to have to look once again at some kind of fiscal stimulus. Now, when you were before us a few months ago, you said, I'm not ready for any fiscal stimulus now, but I don't rule it out. I'm saying to you that in spite of your earlier testimony that we regret fiscal stimulus later if we turn to it, I think that's ultimately where we're going to turn, particularly with this pressure that the Germans are putting on the dollar. What say you to that, Mr. Chairman?
Well, let me just say as a general rule on this particular subject, I certainly see no net benefit to the U.S. economy from depreciating the dollar further. I don't believe, as some people do, that somehow we can galvanize the economy essentially by trying to spur exports at the expense of others in the international community. So clearly that is not an avenue of...
so then we must bolster the dollar.
I'm sorry?
So then we must bolster the dollar.
Well, I would prefer not to comment, if I may, on any details of policy directly, because I don't think it's, I can do that without having unnecessary market effects.
Well, Mr. Chairman, if you may, if I may, if Chairman Sasser will yield, I don't think we want you to comment in terms of the specific policy options that you may be planning right now or contingencies that you may have, but I think you owe us some illumination of the quandary that we seem to be in. I mean, we did have a very unsettled day yesterday in the currency markets until there was an intervention, and the higher German interest rates are a fact of life. They've now happened, and we've got to deal with them. And I see that working in an adverse way on our economy. I think Senator Sasser's exactly right. High German interest rates don't help us. I mean, they just wedge us into a tighter corner, and I think they wedged the Fed into a tighter corner.
Well,
And
may I just, Mr. Chairman, let's, leaving aside the overall general levels, remember that the actions that the Germans took the other day were to raise the discount rate, but the discount rate in Germany, in and of itself, does not move the market rates. And the market rates did not move very much, so that it's the market rates which effectively function relevant to our market rates in inducing capital flows. The reason why there is a considerable expectation of rising German rates is that usually the Lombard rate, which is the effective rate to which borrowing is made, is usually raised when the discount rate is concerned, and there's been market expectation that would happen, and that's where a lot of the conversation and concern and anticipation has occurred. But I don't know of anything which suggests that what's going to happen. But at the moment, we have not seen a rise in effective market rates so far as the Germans are concerned.
well, it doesn't change the quandary that we're in, and I don't know that you would really take exception to
No,
it.
I'm not. I'm just making this as a collateral remark.
And I appreciate, and Senator Sasser appreciates the sensitivity of anything you say in this area at this time, and we're not trying to push you into saying something that you're not ready to say. But I want to express the concern that I have, that I think that we've now gotten ourselves positioned and we're wedged into a corner here where events in foreign countries, like, for example, interest rate decisions in Germany, are becoming very, very difficult for us to be able to deal with because of their implications for us and how weak our economy is and how we've weakened it over a period of time. It hasn't just been the last 2 or 3 years. If you go back over the last 10 years, I think you can see a progressive weakening of our economy. We got a terrible trade problem. Our productivity problem has not been solved, quite frankly, despite some improvement. We got a long way to go in that area. Huge unemployment problem, huge structural deficit problem, and we still have very high long interest rates and high real interest rates over and above inflation. And so you've brought down the short rates. In fact, the short rates today are actually, somebody has argued that they're actually, in effect, when you take out the inflation factor, are available at less than zero. I mean that the effective rate of short-term borrowing is more than offset by just the inflation over a year's period of time. I mean, that is quite extraordinary, and it's a long time since we've seen anything like it. The problem is we're not getting the lift in the economy. We're not getting the job creation. We're not getting the kind of strong, sustained recovery that we need to have. And I don't think it's good enough in the end simply to acknowledge all that and say, well, the world's changed and we're still trying to make sense out of it, but this is the best we can do. I think the public is asking for more than that, and I think they have a right to expect more than that. And I would hope that you would go back and talk to the other Fed governors. I mean, you've heard an expression of opinion of members on both sides of the aisle here. Of course, some members were not able to be here today. But I think you're hearing enough of a concern broadly stated from people from different regions and different parties that I think it's input that you need to weigh carefully, and that I would hope that the other members of the Board of Governors would weigh carefully. And if, in fact, you're out to the end limits of what you can do, and that's the cold, hard fact of the matter, then I think we have to begin a discussion about what other tools are available in other directions. And you have to be prepared to get into that discussion, and I think we in the Congress do as well. The people want answers, and I think we're not providing them. I don't think we've given them that today with this monetary policy review and outlook. I think it just doesn't do the job, and so more is going to have to be done. I might just further say that tomorrow here we'll be meeting again. We'll have Lester Thoreau, the Dean of the MIT School of Management. We'll have Mr. Pete Peterson, a former Commerce Secretary, and Professor Robert Eisner of the Economics Department at Northwestern, who will be commenting on these same issues. And then again, we'll have some witnesses on Wednesday, Mr. Pat Choate, Mr. Lee Thompson, CEO of Smith Corona, to come in and talk about some of these same issues as to what's wrong with the economy and how do we fix it. Chairman Greenspan, we thank you for your appearance today. You've been very patient. We appreciate that. Committee stands in recess.
Yeah.